This is Professor Rakesh Mishra. Welcome to JK Shah classes. By qualification, I am a chartered accountant. I teach law subject and direct tax subject at final CA and inter CA level since more than 14 years. Today, we will going to discuss revision test paper applicable for May 23 attempt. So, this is recently released by ICAI. Along with the revision test paper in which I am going to discuss, basically I am going to discuss two things in that, the amendments as well as the question answers given by the ICAI. There are certain things I want every student to take care while viewing this lecture. Number one, this is the amendment of May 23. So, there are several amendments which is old amendment which we have already discussed in the last RTP. So, those amendment I am not going to cover again. So, what we can do after watching the entire RTP, which I am going to upload this, you have to immediately go and see the amendment video of November 22 CA Final Law, which is also there at JKSC portal, and that has been also recorded by me. So, after once you will view those two videos, the entire amendment will get covered. This video I am trying to keep it as short as possible, but as you know that there are lot of amendments have been released by ICAI. So, I will try to keep it compact but comprehensive, and I will try to cover everything in this. Just listen everything line by line, and I am sure you will going to be comfortable with everything. So, without wasting any time, now let us start with the amendments first. Now, this is already I have written here. Along with this amendment video, also view amendment video of November 22, which is already there on the ICAI portal. Now, let us start with the amendments. See, as I have already told you, those amendments which I have already covered in November 22, those old amendments, we are not going to repeat again. So, those students who have learned under us long back and have not seen those amendments can see the video of November 22 after this video of May 23 amendments. So, now let us start. The first amendment in which I am going to do the discussion is from the Directors chapter. So, this amendment is from the Directors chapter. You can see this is I am referring your ICAI material only, so that you will not get any confusion. On page number 5, this amendment is from the chapter Directors. I have also written section number for your reference, section 152.5. First, let us revise shortly what is section 152.5. Can I say under 152.5, any person want to become director in the company. So, to become director in the company, you have to file form DIR 2, in which you give consent that if you get appointed as a director of the company, you are ready to act as a director of the company. So, in this, they have just added one more line. What is that? Please understand. See, whenever you will make an application under 152.5, that is the consent that you are ready to act as a director, that you file in form DIR 2. Now, this says that if you are a person, that the person is a national of a country which shares land border with India, that person, for example, a person who is a Pakistan national. Why I have written this? A Pakistan national shares what? Tell me fast. Pakistan national shares land border with India. So, any person who is a national of a country which shares land border with India, if that person along with consent also need to give security clearance from a Ministry of Home Affairs. So, to put it in simple language, let us say my company name is X Limited, and in X Limited, let us say I want to appoint Mr. Y, and let us say Mr. Y belong to Pakistan. So, so obviously when he will be filing 152.5, in which he will file DIR 2, which is nothing but a consent to act as a director of the company. So, along with that consent, if the person is of any country which shares land border with India, for example, Pakistan or Bangladesh. So these shares land border with India. So along with DI2, that is consent, they will also give the clearance of Ministry of Home Affairs. So if I am a Pakistan national, before becoming a director in X Limited, I will take clearance from a Ministry of Home Affairs, security clearance, and along with those security clearance, I will also give DI2 form consent, and then after only I can become the director of the company. So I hope it is very straight and simple. Now, see, one more point in this only I will tell you. When you make an application for DIN, so the moment you make an application for DIN, there is an application number get generated once you make the application. So this is the normal procedure, that once you make an application for DIN, the moment you make an application for DIN, application number get generated. But if you are a person of a national of a country which shares land border with India, for example Pakistan national if you are, then in that situation, can I say that number will not get generated? No application number will be generated unless that security clearance is taken from Ministry of Home Affairs. So let's say if there is a company in India X Limited, and let's say Mr. Y is a Pakistan national who want to become director in X Limited, that is in India. So once he will make an application, his number will not generated. What he have to do? Once he will make an application for DIN, before that he have to take Ministry of Home Affairs clearance, and once he will take that clearance, after only that, can I say, application number will get generated. So this is in order to ensure that the person coming from Pakistan, Bangladesh, can I say, they get security check from MAOH, that is Ministry of Home Affairs, and no harm they can do in India. So basically the reason is now very obvious. You must have understood why they are doing this. So this is like that. So these two amendments are there in director. I hope it is clear. Let's proceed. Now another, if you know under 149 you become independent director, and for that there is a section 150. They says that if you want to become an independent director, so before becoming an independent director, the criteria is, before becoming an independent director, the criteria is your name should be there in the data bank of independent director. So let's say if there is a company X Limited and they want to appoint, let's say Mr. Y, and Mr. Y can become independent director in X Limited only and only when Mr. Y's name is there in data bank. And there was a provision which is still there now. What is the provision? That if your name will be there in data bank, and from there you have to pass an exam within a certain time limit, which you have already studied, within a certain time limit. So can I say, if Mr. Y want to become an independent director in any company in India, like in any company means those regulations for independent director. So if Mr. Y want to become independent director in India, so his name has to be there in data bank for independent director. Now let's say he has already enrolled and his name is already there in data bank for an independent director. Now from that, within a certain time limit, he has to pass an exam. Now I am going to discuss that important point. And now let's say if he does not pass the exam within that time limit, again I am repeating, if he does not pass an exam within the time limit, then his name will be removed from the data bank. What I told you, then his name will be removed from the data bank if he does not pass an exam within the time limit. Now these provisions are already there, so that's why I have not discussed in detail, but his name will be removed from the data bank. Now he has a condition. Now he has to, if he want, now what is an amendment? So let's say Mr. Y's name was there in data bank, but he failed to pass an exam within time limit. Now his name will be removed from the data bank. But now the amendment is, his name can be restored. This is very important. His name can be restored. Look here. His name can be restored if he make the fees of rupees 1000. So this is an amendment. So let's say if Mr. Y's name has been removed from the data bank because he could not clear an exam, so he can again put the name, he can again put an application for restoration of the name, and he has to give rupees 1000 as a fees. Now let's say his name has been restored. Now it will be appear in restored category for 1 year. It will be appeared in restored category for 1 year, and within that 1 year period he has to again pass an exam. Once he failed an exam, because of that his name has been removed from the data bank. Now he made the fees of rupees 1000 and he has made an application for restoration, his name in the data bank. So his name will be restored, but now his name will not be there in a proper data bank side. There will be a separate restored category in that, and there his name will appear for 1 year, and within that 1 year, once his name has been restored, from there within 1 year he has to pass online proficiency test. He has to pass that test within 1 year once his name has been restored, and once he pass an exam within that time limit, that is 1 year, his name will continue to be valid. His name will be continue to be valid. Not only that, can I say, once the initially he must have paid any fees, so that fees will be continue. For example, X amount he has paid initially, and for that, let's say his license is valid for X period. So even though his name has been restored again, the original fees which he has paid, can I say that fees will continue for him. So he don't have to pay the extra fees. So at the time of initial registration, whatever the fees he has paid, that fees will only continue, and once he passed that exam within 1 year, his name from a separate category will appear in the normal data bank, and the original fees which he has paid will only continue for him, and he don't have to pay the extra fees again. So this is one point. Now, but what if he fails to pass that exam within 1 year? So his name got restored, he paid 1000 rupees, his name got restored, and within 1 year he has to pass the online exam. But let's say he failed to pass that online exam within 1 year, then in that situation again his name will be removed from the data bank. And now if he want his name to appear in the data bank, he has to make the fresh application. So this is very important, he has to make the fresh application. So the original registration fees which he has paid will lapse, and once he will make a fresh registration, he has to give a fresh fees, and again he has to undergo with all the procedure for registration. So to put this entire thing in nutshell, what I will tell you, see, let's say if your name has been removed from the data bank. So if your name has been removed from the data bank because you could not pass an exam within the time limit, so now what you can do, you can pay 1000 rupees and you can make an application for restoration of your name, and your name will be restored, but now it will appear in separate restored category. And now within 1 year, once your name got restored, you have to pass an online exam, and let's say if you pass that online exam within 1 year, then your name will continue to be valid. And the original fees which you have paid at the time of original registration will also be continue to be valid. But let's say if you fail to pass that exam within 1 year from the period your name got restored, then in that situation your name will be removed again. And now if you want to put your name back in the data bank, you have to make a fresh application. That means you have to give the fresh fees. So this is all for directors chapter. Now we will move to the new amendment. See, those amendment, LODR and all in between, you are saying I am not discussing those amendments because those amendments are already there in November 22. So those who have recently studied or those who have studied earlier but have already seen November 22 videos, those people already know these amendments. If you have not seen it, then in that situation, once this video will get over, just see the November 22 video and your entire amendment will get completed. Now, I am moving on to the next amendment. Next amendment, I am doing the discussion from a chapter FCRA, Foreign Contribution Regulation Act. Now in this, you must have studied there is a prohibition in section 3 to receive foreign contribution, and immediately after that, you must have studied the list where a person to whom section 3 does not apply, means the person to whom the prohibition does not apply. This provision you already remember. Now in that you must have studied one point, that if you receive a foreign contribution from a relative, again I am repeating, if you receive a foreign contribution from a relative, in that situation it is not prohibited. I hope you could recollect the provision now. So if you are receiving foreign contribution from relative, in that situation the prohibition is not applicable, but in that situation you have to inform to the central government, inform FC1. So there was a provision, this provision is still there. What is an amendment? I will tell you. Earlier, when you receive a foreign contribution from relative, you have to inform to central government in form FC1 within 30 days, and only when the amount is above 1 lakh. Now there are two amendments. Number one, the amount of 1 lakh has been deleted, and now they have inserted the word 10 lakhs, and the word 30 days have been deleted, and they have inserted the word 3 months. So now if I will put this in the new form, what is the new rule now? That what is the provision? That there are certain persons who all are prohibited to receive foreign contribution. And then there is an exception. Under that exception, they say that if you are receiving a foreign contribution from a relative, you don't have, there is no prohibition, but the only thing is that you have to inform it to central government in form FC1. Now the new rule says that if you receive a foreign contribution from relative, you have to inform it to central government in form FC1 only when the foreign contribution which you have received from the relative is above rupees 10 lakhs. Again I am repeating, you have to inform it to central government in form FC1 only when the foreign contribution which you have received from the relative is above rupees 10 lakhs. 10 lakhs, and that too you have to inform it within 3 months. So within what period you have to inform? Within 3 months. So now you don't have to intimate when the value is above 1 lakh, you have to intimate it when the value is above 10 lakhs, and now you don't have to intimate it within 30 days, you have to intimate it within 3 months. So these are some amendments. I don't think so you are finding it very difficult to understand. Now again I am moving on to the next point. What is the next point? Can I say, if any order is passed by Ministry of Home Affairs, and if you are finding that order has some mistake, apparent mistake, so for a revision of order you make an application in section 32. First of all, I hope try to recollect this point, and then only you will understand this amendment. See, when there is a order passed by the central government, and let's say there is some apparent mistake in that order. So when there is an apparent mistake in that order, in that situation, can I say, for revision of order made by the central government in which there is an apparent mistake, you can make an application within 1 year or from the date order known, like that. 1 year from the date order passed or known, that period we'll learn shortly. But can I say that revision order, you have to make an application for the revision of the order passed by the central government. Can I say only when the mistake is apparent? That provision is already there in section 32. That provision is still there. But in that there is a rule 20. Now what is an amendment in that rule 20 related to section 32 that I am going to discuss? So when there is a mistake in the order of the central government, and if the mistake is apparent, in that situation you make an application. Again I am repeating, you make an application to central government for revision of an order. So earlier they used to write that the application will be made in plain paper. Now they have deleted that word and they have inserted the word in such form or manner, including electronic form as may be specified. It means earlier when you used to make an application to central government, you used to make an application in plain paper. For revision of order, when you used to make an application, you used to make an application in plain paper. Now you will not going to make an application in plain paper. Now that application will be in the electronic form. So this is one major amendment they have brought. Now just to clarify those amendments, they have given FAQs, which is very easy, don't worry. So once I will discuss those FAQs, you will understand the entire provision very easily. Now let us understand what is FAQ. So who is eligible to submit revision application? So very simple, any person who is aggrieved by an order of the central government may make an application for revision of an order to central government. So this is the first question's answer. Second, how can an association file an application for revision order? So earlier they used the word plain paper, now they have deleted. Why? Because now the application is not manual, now the application is electronic. So can I say, when you will make an application for revision of an order which is passed by the central government, and if the mistake is apparent, then only you can make an application under section 32 now. So that application now you can make only by way of electronic mode. So now you can make an revision orders application only in electronic form. So this is second point. Third point, can revision application be sent through physical mode? Answer is no. Can I say now the application can be made only through electronic? So for that electronic word they have inserted so much of FAQs. And now once you will make an application electronically, so you need to know how you will make an application, because now you want to make an application for revision of order. So what will be the procedure? So this says that first go to FCRA web portal. Under that FCRA web portal, can I say there is a separate segment under the FCRA web portal, there is a separate segment under which there is a service under FCRA. So you will go to service under FCRA portion, and under that service order FCRA portion, there is a heading revision application against section 32. There you have to click and make an revision application. So let's say, I will put it even in a simple language. Can I say, let's say you are not happy with any order passed by the central government, and you feel that the order, there is a apparent mistake in the order, and now you want to make an application so that CG can revise that order. So now the order cannot be filed in plain paper, you have to make it electronically. So for that what you will do, you will go to FCRA portal. So on Google you will file fcraonline.nic.in, I mean on that thing where you put that address of web address. So there you will file fcraonline.nic.in. There will be a segment there, service under FCRA. You will click there, and after that you will click to service application against section 32, and there once you will click, you will make an application for revision. Whatever problem you have, you will just, your grievance you will put there in that way, so that CG will receive it. I hope now it is clear. Is it required to send physical copy of electronic filed revision application to Ministry of Home Affairs? So you make a electronic application, and once you will make the electronic application, whether that electronic application's physical copy you need to send it to MHA. So this is a question. So answer is no, no need. Means once you made the electronic application, your job got completed. You don't have to do any further act. The things got there itself completed. Is there any format for revision of application? No, there is no format. So again in that electronic form also there is no format. In a plain paper only you will make an application, but the only thing is that now it will not be a physical paper, it will be a scanned copy of a plain paper, and that you will put in that portal which just now I told you. So please don't get confused. Plain paper, earlier they used to talk about physical. Now they are saying that scanned copy of plain paper. That scanned copy of plain paper, can I say that you will file but electronically. You will just upload that scanned copy which is signed by you. Clear? So now you can just understand the application mode is shifted from physical to electronic. Is applicant required to submit justification for revision of order? So they are saying yes, justification for revision of order must be submitted, and that need to be submitted along with supporting document. Obviously, if you are saying that the order the mistake is apparent and it need to be revised, so obviously you must be having something to support that. So you have to give that also, justification also. What is the fees you will give for making an application for revision order? So this is the fees will be rupees 3000. And that will pay through gateway specified by central government, payment gateway specified by central government. Next question, what is the time limit for making an application for revision of an order passed by the competent authority? So it is already what you have studied, the same thing is going on. Within 1 year you will make an application. 1 year from the date it is communicated, or from the date that order known to you, whichever is earlier. So this was already earlier, so same provision is there. So I am not going to go into detail. So major amendment here was only that instead of manual, now there is a electronic filing. So this is all for FCRA amendment. Now we will go to amendment of IBC. So now let us understand this IBC amendment. In this first amendment, you know, when there is a replacement of liquidator, after the liquidator get replaced, the liquidator has to inform it to IBBI. They have to intimate it to IBBI. So now the amendment is over here. So earlier the provision was that once the liquidator get replaced, that means if old liquidator goes and new liquidator comes in, so the new liquidator has to intimate it to IBBI, and the time limit to intimate it to IBBI was 3 days. Now they have deleted it. Now the new provision is 7 days. What this is? The insolvency provision. Read this. The insolvency professional shall within 7 days of his appointment as liquidator intimate to IBBI about such appointment. So now what is the new rule? That once the old liquidator goes, new liquidator comes in. That is liquidator replaced by the new liquidator. So once the new liquidator will come, from the day he come, from there within next 7 days, instead of 3 days, now within next 7 days, he has to intimate this to whom? He has to intimate this to IBBI. So this is an amendment, very simple amendment. Now another amendment is in section 7. You know, under section 7, application is made by financial creditor for corporate insolvency resolution process. Under that, they have to make an application under section 7 to NCLT. And in that they make an application in form 1 and rupees 25,000 is the fees. So this is the normal procedure. But now what is the extra point they have added? This is an amendment. What is the extra point? That the applicant shall serve a copy of application to registered office of the corporate debtor by registered post, speed post, or by hand or by electronic means. So to put it in simple language, can I say, let's say Kingfisher is there, corporate debtor, and SBI is a financial creditor. Now let's say SBI want to make an application to NCLT against Kingfisher in section 7. In that situation, what will happen? SBI cannot, these are just a hypothetical name just to explain you this provision. So NCLT, before making an application to NCLT under section 7, to NCLT against Kingfisher by SBI, SBI will make an application under section 7 because it's a financial creditor. So what SBI will do, SBI will also serve a copy of this application at the registered office of the Kingfisher and to IBBI. And so can I say this application copy, before making it to NCLT, before filing it to NCLT, they will serve this copy to Kingfisher as well as IBBI. And this copy they can send either by registered post or by speed post or by hand delivery or by electronic means. So I hope you all are finding these amendments very easy, manageable. Now, next point, determination of valuation of claim by liquidator. I can say there is a process now. Whenever any claim is made to liquidator, what liquidator do? Liquidator verify that claim and then they determine whether the claim is correct or not, whether it should be reduced or it should be cancelled or it should be taken at the face value or at the same value, whatever value it has been given. So it is a process of verification of the claim, and this verification of claim is done by liquidator. So all the provisions which you have studied is same only. One extra point they have inserted, provided that the liquidator shall also verify the claim collated during the CIRP but not submitted during liquidation process within 30 days from the last date of receipt of claim during liquidation process, and may either reject or accept. Means what they are saying, please understand again, read along with me. Provided that the liquidator shall also verify the claim collected during CIRP but not submitted during liquidation process. So let's say there is any claim made by any person. Now that claim is not submitted during liquidation process, but that is given under which process? CIRP process, but not during liquidation process. So even that claim he can verify within how many days? Within 30 days from the last date of receipt of claim during liquidation process. So whenever the last claim has been received during liquidation process, from there within 30 days he can verify such claims. So very easy, manageable. Shall we proceed? In now, meeting of COC, Committee of Creditors meeting. So you know, a resolution professional or liquidator can call meeting as many times as they want. There is no restriction. So that provision is still there, that if they want to call any meeting at any given point of time, they can call the meeting, absolutely okay, no problem at all. But now what is an amendment that we are going to discuss? Please understand. They are saying for the purpose of subsection regulation 2, it is clarified that meeting may be convened under this sub-regulation till the RP is approved under this section or under liquidation, and decide on the matter which do not affect the resolution plan submitted before NCLT. Means what? Can I say there are two questions over here. Till what period RP can call the meeting? till what period resolution professional can call the meeting of COC. So they says they can call the meeting of COC till any period. That is absolutely fine. That is not a problem. But what they are saying, that let's say if the plan is submitted, now plan is submitted, resolution plan is submitted to NCLT, and it is pending with NCLT, and now within some days NCLT will either approve the resolution plan or reject the resolution plan. So during that period there are some restriction which they are saying. Can I say what they are saying, that the plan is already approved by COC and now it is given to NCLT. Now it is pending before NCLT, and now NCLT can either reject the plan, and if the NCLT will reject the plan, liquidation will start, and if NCLT approves the plan, resolution process will start. But what they are saying, that plan has been submitted, but still till date NCLT has either not accepted or rejected, means it is still pending with NCLT, and NCLT is thinking whether NCLT should accept the plan or reject the plan. During that period, if meeting has been called of COC, if committee of creditors meeting has been called, so this is in that meeting they can discuss any matter they want, but that matter should not affect the resolution plan which is already given to the NCLT. Why? Because can I say it is still pending with NCLT. So how NCLT will decide? Because NCLT will decide on the basis of plan which is already submitted to them. So this is, you are calling a meeting, please call, no problem. But in that meeting, please don't discuss anything which is going to affect the plan, resolution plan, which is pending before NCLT. So this is an amendment they have brought. I hope it is clear. So all amendment of IBC is also completed. Okay, now we are moving on to the next amendment. This amendment is for Foreign Exchange Management Act, FEMA chapter. As you all know that FEMA is a very big chapter. In fact, in this, the major amendment they have brought, major amendment as in they have inserted one new concept, overseas direct investment. So it is a very lengthy part. I will try to explain you in a simplified way as well as in brief way. Like I'll try to cover almost everything, but in an easy way so that you will retain it. Otherwise what will happen, the chapter is already so big, and if I'll explain you in a very lengthy way, you may lose the interest and you may not able to remember it. So the very first thing, there are some amendments which we have already discussed in November 22. So those amendments we will not going to discuss again. The new amendment which they have inserted by way of ODI, new regulations they have inserted, that regulation will discuss. So now let us start with this. See, the amendment is overseas investment rules. This is the new rules they have inserted. Earlier there was a foreign exchange transfer of issue of foreign security rules. Second was acquisition of transfer of immovable property regulations rules 2015. These two rules have been deleted. So they have deleted these rules, and against which they have inserted this rules, foreign exchange management overseas investment rules. So first thing I hope is clear to everyone in this classroom. Now let us understand what is the new point. Let us understand. So in this, first is, now line by line I will explain you. So now we are going to discuss these rules, foreign exchange management overseas investment rules. So can I say we will learn about overseas investment. Now what is overseas investment? I will give you briefing about that, and what are the provision of these rules that we'll learn. Please understand. See what happens in real life. I'll tell you. I am an Indian investor and I want to invest into a foreign country. So that is an overseas investment. Are you understanding? So let's say Mukesh Ambani or Reliance Industries Limited is buying, let's say, equity of, let's say, Facebook, or shares of, let's say, Microsoft. So you can call it as a overseas investment. So when an Indian investor is acquiring shares etc. in a foreign country, this will be called as what? Overseas investment. I have explained you in a layman term this thing. Clear? So now let us understand whatever the overseas investment concept. First is some definitions are there, very easy, not need to mug up it, just understand it nicely. So first they have explained, they have used the word act. What is the meaning of act? So wherever they have used the word act, it stands for Foreign Exchange Management Act. Now then, what is the meaning of authorized dealer? Hey, you already know, when I was teaching you FEMA chapter, that time I told you what is overseas authorized dealer. So I told you money changer, offshore banking unit. Remember, authorized dealer. So like that, I already explained you. So those things which we have already studied in FEMA is also applicable over here. But here, whenever they use authorized dealer, they are using in the context of domestic branches of AD bank. So whenever they will discuss what word authorized dealer, they will be referring what domestic branches of AD bank. So domestic branches of AD bank will be here as a authorized dealer. Now, what is the meaning of control? So, by what ways you will take control? So, this is control means a right to appoint majority of director, number one. So, when you can appoint majority of directors of the other entity, so you will say that you are controlling that entity. For example, other entity has 7 directors, and if I can appoint 4 directors out of it, that means I can say that I am having a control. Or, number 2, can I say if they are making any major policies, and if I have a control on making of their major policies, means basically the other entity, whatever the major policies they are making. So if they are asking me, or I can say that I decide what major policy changes should be, then in that means can I say I am controlling that other entity. So this is again that major policies you can decide. Or you are having more than 10% shares, like you are having 10% or more voting rights, even that can be treated as what? Control. So these are 3 things of control they said. Then they will use the word disinvestment. What is disinvestment? It's very simple thing. Investment means what? When you buy any shares, debentures, you can say you are doing investment, but here they are talking in context of equity capital. So when you are buying equity capital, that is an investment. So when you are selling equity capital, either full equity capital or some part of equity capital, you will call it disinvestment. To put it in simple language, can I say sale? Selling means disinvestment. So if I'll sell the entire equity, you will say full extinguishment, or partial equity if I have sold, then it is partial disinvestment, like that. Clear? Now next point, equity capital. So same meaning, whatever we know about equity capital is same over here also. So we are not reading it. Now there are some major thing which you have to understand. This is the major part which is very important to learn the entire chapter. First in that is financial capital. Now beta, what is financial capital? Let us understand this. First thing we'll learn financial capital. Second, what we'll learn is, look here. First we'll learn financial capital. Then we'll learn ODI. Then we'll learn OPI. Then we'll learn overseas investment. So what we'll all learn over here? Financial capital. Then we'll learn ODI. Then we'll learn, tell me, OPI. And then we'll learn overseas investment. So let us learn one by one. First I will teach you financial capital. Once everything will get over, we'll consolidate it. So what is financial capital? So this is, look here, this is financial capital means aggregate amount of investment made by a person resident in India. What I told you, you can say Indian investor. Indian investor is making investment outside India. So can I say the money which is going outside India, by whom? By Indian investor. In a layman term, can I say it is a financial commitment, but not precisely. Now I will tell you the precise definition. So can I say what is financial commitment? So when an Indian investor, that is person resident in India, is making investment by way of ODI. What is ODI? I'll teach you in some time. Or by making by way of debt, other than OPI. So they will not include OPI, fine, in a foreign entity, and it shall also include non-based fund facility. So I will simplify this for you. These are some tricky definitions. You have to have patience to understand this. So but in some time we will understand everything. See what they are saying. Financial commitment means what? So this is financial commitment will include what? So financial commitment will include number 1, ODI. So let's say the Indian party, look here, look here, the Indian party is making an investment outside India. So when an Indian investor is making an investment outside India, and when you will call it as financial commitment, so this is whatever the money is sent by way of ODI will be included, whatever the money sent by way of debt will be included. ODI I will teach you in some time, debt you already know, debentures etc., loan etc. Then whatever by way of non-fund based facility, that also will be included. What is non-fund based facility? You can remember like a performance guarantee, that if some other party will not do certain activity, I am going to pay you for that. If the other party failed to do certain, activity, I am going to pay you for that. So when they do this, this is called non-fund based facility. So they will, in a financial commitment, so you can remember non-fund based facility like a performance guarantee. So in financial commitment, you will include three things. Number one, ODI. Number two, debt. Number three, non-fund based facility. In financial commitment, you will not include OPI. See, this is what they have written. Now, financial commitment include aggregate of investment made by resident, obviously because Indian investor is investing outside India. So made by resident by way of ODI. So ODI is included, overseas direct investment, but it does not include OPI. So I have reduced it, but it will include non-fund based facility. So I have included that non-fund based facility. So I have added these three things and reduced OPI. And now I will tell you what is ODI and those other things which is used over there. See, what is ODI? Just now we said na, that financial commitment will include ODI. So what is ODI? So can I say ODI means investment by way of, so when an Indian investor is investing by way of acquiring unlisted equity capital. So if there is a foreign entity, just for some time you can remember Facebook, Microsoft, these are foreign entity. So but here what they are saying, if the foreign entity is unlisted company, then buying shares, equity shares of unlisted entity is included as a overseas direct investment. Or if you are doing subscription by way of memorandum, so can I say like kind of promoter kind of thing, that you are subscribing to the memorandum, even that will be of obviously foreign entity. Here everything will be for a foreign entity because an Indian investor is not investing in India. The Indian investor is investing outside India. So whatever I am using, I will be using for an foreign entity. Or when you are making an investment, the value is 10% or more of a paid up share capital of a listed foreign entity. Here listed foreign entity. See, if there is an unlisted equity capital, any percentage will be qualified, because normally in unlisted company, if you are buying a shares, equity shares, it is usually a big percentage only, but the criteria is not like that. But usually you take, see, ODI is more like taking ownership. ODI is more like taking ownership. So in an unlisted companies, having equity capital itself is like a ownership, and that's why in an unlisted company, any percentage of equity capital you are holding, that is ODI. Memorandum, subscribing to memorandum is like holding an ownership, it is ODI. But in a listed entity, just having a shares will not give you kind of ownership. So they are saying you should have 10% holding in that. Or if you are having less than 10% investment in equity capital, then in that case you should have control. So what they are saying in ODI, if it is a unlisted entity, if it is a unlisted entity, then you should have equity capital, any percentage. Or if you are if in a foreign entity, FE stands for foreign entity. So in a foreign entity, if you are subscribing to the memorandum, even that is ODI. Or if it is a listed foreign company, foreign entity, in that case you should hold at least 10%. Or if you are holding less than 10% in a listed foreign entity, then in that case you should have what? Should have control. So can I say ODI is like kind of taking ownership, you can remember. So in that case there are four ways. If that foreign entity is unlisted, then holding any equity capital. Or if you are subscribing to the memorandum of that foreign entity, then also it is ODI kind of ownership. Or if it is listed, then either you should have 10% of share capital or you should have control. In either of the situation, having 10%, then it will be treated as ODI. Having less than 10% but having control, then also it will be treated as ODI. I hope it is clear to everybody. So this is what they are saying. Now in this point what they are saying, that let's say there is a foreign entity and now it is listed and you are holding 12% and subsequently you have sold 4%. Now you are having only 8%, only 8%. So they are saying once ODI is always ODI. Means if I am already holding more than 10% in any foreign entity and subsequently if I sell my some stake and because of that if he falls below the definition and now let's say if it does not hold that much percentage due to which it can be called as ODI. This is, but still it will be treated as ODI. Means once an ODI will always be treated as an ODI. So see what they have written. For the purpose of this clause, where an investment by a PRI in equity capital of a foreign entity is classified as ODI, such investment shall continue to be treated as ODI even if the investment fall below level of 10% of that entity. I hope it is clear. So once an ODI, always an ODI. So let's say I am holding any foreign company's 12% shares. It is an ODI for me. Now let's say I have sold 4% or 5%. So now the limit is no more 10%, and being since it is a foreign entity, since it is a listed foreign entity, now it will not be qualified to, supposed to be not be qualified to be an ODI, but this is since earlier it was called to be an ODI, now it will be continue to be called an ODI. So even if you are falling below the limit of ODI, you will still be treated as ODI. Clear? So this is ODI is completed. Now I will teach you what is OPI. Overseas portfolio investment. OPI. Please understand. This is OPI means an investment other than ODI in foreign security, but does not include any unlisted debt instrument. Now it is a very simple thing. They have just given this in a complicated way. I'll tell you. See what they are saying. OPI means investment other than ODI in foreign securities. Means what? I can say what is ODI? ODI means having a controlling interest. So if you are having a controlling interest kind of thing, then it can be qualified to be as an ODI. It means if you are making an investment in the foreign entity, but after making that investment in the foreign entity, still you are just having like a normal investment, you are not trying to take control or kind of that thing on that foreign entity, then it will not be called as ODI, it will be called as OPI. For example, can I say like Rakesh Junjunwala, he is investing in so many companies, little in so many companies. Example I am telling you. So can I say now that can be called as OPI? But let's say Rakesh Junjunwala is buying 70% shares of one company or a heavy amount of shares of some company. So now that is OPI. That is not something a big amount. Normally it is just to explain you. Now I will teach you definition, but to explain you, if you are holding something which is empowering you kind of control, that can be called ODI. But you are just like an investor, little amount you are investing in so many companies. Now it will not be qualified to be as ODI, but it will be qualified to be as OPI. Now that same understanding you will understand, you will get from the definition. Overseas portfolio investment means I am investing in foreign security, but I am investing only that much that it is not becoming ODI. So it will become OPI. For example, earlier what I told you, can I say, let's say in a listed company, when you are investing 10%, for example, let's say in a listed company, let's say any company, you say, let's say Microsoft, you are investing 12%. So it's a listed foreign entity, it is ODI. But in Microsoft, let's say if you are investing only 3%, so it is not ODI now, because it's a listed entity and your investment is less than 10%, and obviously you don't have control also. So it is less than 10% and you don't have control, so it is not ODI, then it will be OPI. So investment other than ODI in a foreign securities. Then they have just clarified that securities of an unlisted debt investment instrument, if you have taken, then it will not be treated as OPI. Means can I say whatever number of shares I am buying of an unlisted debt instrument, that will always be qualified to be an ODI, because for an obvious reason, usually in any unlisted company, whenever you take any investment, whenever you make any investment, usually you have a controlling interest, and government understand this, and that's why they have clearly said that whatever investment you make in unlisted debt instrument, that will not be qualified as OPI, that will be qualified as ODI. So what is ODI? First, can say unlisted entity you invest, or a listed entity 10% or more, or less than 10%, then controlling of that listed foreign entity or subscriber of memorandum. And what is OPI? OPI, this is whatever investment you are doing in foreign security, but if it does not fall as a ODI, it will fall as a OPI. But if you are making an investment in unlisted debt instrument, it is always treated as what? ODI. It will not be treated as OPI. Clear? Overseas portfolio investment. So OPI means an investment other than ODI in foreign security, but it does not include unlisted debt instrument or any securities by PRI. In some time I will teach you about IFSC, you will understand this last line, but right now just read till here. So OPI means investment other than ODI, and it does not include unlisted debt instrument. Again same point, let's say any investment, earlier it was OPI, later on, see OPI means a resident who has invested into equity capital of listed entity, even after it become delisted, it will continue to be treated as OPI. Means what? Just now I told you, see, if you are making any investment, just now I told you, if you are making any investment, where if you are making any investment in listed entity, and if it is less than 10% and you don't have control, let's say like I am investing 1% shares in Microsoft, and let's say it is a listed entity, so and I don't have control also, so that 1% will not be qualified to be called as ODI. Now it will be called as OPI. Now what they are saying, that once that listed entity get converted as unlisted, let's say Microsoft is listed, it got converted into unlisted, so can you say technically investment in unlisted is ODI and not OPI na? But this is once an OPI is always an OPI. So can you say if you have invested in any listed entity and very less amount, and because of that entity, because of that your investment is qualified to be called as OPI, and subsequently that foreign entity, let's say Microsoft, got converted, became unlisted, even if it become unlisted, it will still be treated as OPI, and now it will not become ODI. So you can remember, once an ODI, always an ODI, once an OPI, always an OPI. Clear? Shall we proceed? I know these are a bit complicated, but slowly and steadily you will start understanding this. Just have patience and start learning little. Now, next is overseas investment. What is overseas investment? So this is overseas investment include two things. First, financial commitment and OPI. Why? Because under financial commitment, overseas investment means whatever money is going outside India. So can you say under financial commitment you have already included non-fund based amount and ODI, and can you say financial commitment was not included as a OPI. OPI was not included in the financial commitment, but whatever money is going outside India is called as overseas investment. Since financial commitment includes non-fund based amount, it includes ODI, but financial commitment does not include OPI. So OPI need to be included separately na. That's why this is that what is overseas investment, financial commitment and OPI. So in a simple language, can I say ODI plus OPI plus non-fund based amount, everything taken together, which is everything taken together, the investment made by resident, that is Indian investor, will be treated as overseas investment. So whatever the Indian investor is making outside India, whether it is OPI, ODI, whatever, everything taken together will be treated as, for that Indian investor, it will be treated as overseas investment. So overseas investment includes financial commitment plus OPI. So these 4 points were very complicated. See, I tried to simplify it, but as I told you, once you have read this, just once I have explained you, just pause the video, read it once calmly, and I am sure you will understand everything nicely. Now shall we proceed? Let us start. Now, some new point I am going to discuss now. Who is a financial service regulator? This is very simple. Whatever regulatory authority working in the financial segment, they all are financial sector regulator. For example, RBI, then SEBI, then IRDA, then Pension Fund Regulatory Authority, PFRD. These 4 authorities will be treated as what? Financial service regulator. Tell me what is, this is financial service regulator. Then what is foreign entity? Very simple. Can I say Indian investor is making an investment outside India? Na? So outside India, the entity in which the Indian investor is making an investment is called what? Foreign entity. So this is any entity which is registered outside India. Registered outside India is a foreign entity. For example, if I am Rakesh Mishra, or let's say Reliance. Reliance is making an investment in Microsoft. So Microsoft will be foreign entity. One very important point I will tell you, you must be knowing about IFSC, International Financial Service Center, and you must be knowing that International Financial Service Center being in India also, still it is treated as if it is outside India. So can I say wherever they are talking about foreign entity, they are talking about something which is registered outside India. But can I say IFSC, despite of the fact that it is registered in India, it is still treated as a part of outside India only, and that's why whatever investment you are making in IFSC, it is treated as outside India only, and that's why even IFSC is treated as what? Foreign entity. So foreign entity is two things. First, an entity which is registered outside India. Second, IFSC. These two will be treated as what? Foreign entity. But then this is those IFSC which has limited liability. And then this is limited liability does not apply to an entity which is engaged in strategic sector. So to put it in simple language, can I say what are the entities which will be treated as foreign entity? One by one, let us understand this. What are the entities which will be treated as foreign entity? So number one, can I say any foreign entity which is incorporated outside India is a foreign entity, number one. Number two, if it is IFSC, it will be included provided it has a limited liability. But then this is if it is a limited liability, but it will not include if it is in strategic sector. So that IFSC which has a limited liability will be included as a foreign entity. But when it will not be included? When it is into a strategic sector. So can I say government has given a relaxation for a strategic sector because they have kept them outside the purview of definition of foreign entity. So now let us understand what is strategic sector. Government is trying to motivate strategic sector investment by keeping it outside the purview. So I'll tell you. See, this is strategic sector. Strategic sector include energy, natural gas, sectors such as oil, gas, coal, mineral ores, submarines, cable system startups. So these are strategic sectors. So can I say these are some core sector anyways we know. So these are strategic sector. Now, next point, what is host country? Host country. A host country means a foreign country, you can remember. So, can I say if Reliance is making an investment in Microsoft, so Microsoft is in USA, so USA is what? Host country. Is this clear? Foreign country. But as I already told you, IFSC is not in a foreign country, but still it is treated as outside India, na yaar? So, this is a host country means a country including IFSC in which foreign entity is registered or incorporate. So can I say Microsoft is registered in USA. So that USA is a host country when I am making investment in Microsoft. But IFSC, even though it is registered, even if it may be in India, it will still be treated as like, even that will be covered under a host country only, because IFSC is treated as if it is outside India. In all these provisions, we are learning that an Indian party is making investment outside India. Indian party is making investment outside India. So a very important thing, who all will be treated as an Indian entity. Who all will be, tell me fast, will be treated as an Indian entity. So this is company which is registered in India will be treated as Indian entity. Body corporate which is in India is treated as Indian entity. LLP which is registered in India under LLP Act 2008 is an Indian entity, and firm which is registered in India under Partnership Act will be treated as Indian entity. Indian entity is making an investment outside India as a financial commitment or as a overseas investment outside India in a foreign entity. So if when an Indian party is making financial commitment in foreign entity, so I told you foreign entity like Microsoft, Facebook, etc. these things, and then I told you what is overseas investment. So that includes ODI, OPI. Overseas investment includes ODI, OPI, all these things. And then I told you who is making all these investment. So an Indian person is making. So Indian person, here they are saying Indian entity, and in Indian entity, whenever they will use Indian entity is making investment outside India by way of ODI, OPI, you have to read Indian entity as Indian company, Indian body corporate, Indian LLP, Indian partnership firm. Is this clear? Then again and again they have used IFSC meaning. So this is IFSC meaning is same as they have given in section 3 of this IFSC Act 2019. Whenever they will use the word last audited balance sheet, you have to read as if last audited balance sheet means a balance sheet which is not exceeding prior to preceding the date of transaction, not older than 18 months, not older than what, tell me fast, 18 months. For example, can I say I am doing some transaction in, let's say, May 2023, May 2023. So May 2023, so balance sheet as on March 23, can I say this is not older than, the balance sheet is not older than last 18 months. So this balance sheet will be treated as what? Last audited balance sheet. Clear? So the balance sheet which is not older than 18 months will be treated as last audited balance sheet. The next is listed foreign entity. If a foreign entity whose shares are listed on a recognized stock exchange outside India, for example Nasdaq, etc., which is outside India, na yaar. So those foreign entity whose shares, equity shares are listed on those stock exchange, that is stock exchange which is outside India. So to those stock exchange we will call listed foreign entity. And listed Indian company means a company whose equity shares, Indian company whose equity shares is listed in Indian stock exchange, for example BSE, NSE. There those company shares are listed, equity shares are listed, we will call them listed Indian company. Then what is mutual fund? This is whatever given under who all are registered with SEBI will be treated as mutual fund. So obviously we know that you cannot operate as a mutual fund unless you don't get registered with the SEBI. Then what is net worth? So this is, please understand, this is net worth means, can I say net worth means who is having registered partner. Net worth, they have given net worth for two things, for companies and for partnership firm. Very simple. If for company this is net worth has same meaning as given in Companies Act. So whatever is given in Companies Act, same meaning is assigned to net worth over here. So you don't have to learn it separately now, because it is anyways covered under Companies Act. Then this is for a partnership firm, that is registered partnership firm LLP, that is for a partnership firm, what it will be. So number one, you will take capital contribution of partnership firm, then you will add back undistributed profit, that is reserves usually you call, and then you will reduce three things. What? You will reduce accumulated losses, deferred expenditure and miscellaneous expenditure. So usually this is the only the way you calculate net worth, na re? So we will put it in a simple language. See here, what is net worth? So this is for a company, it is same as given in Companies Act. For a partnership firm, what you will take? For a partnership firm, for a company, I already told you, same as Companies Act. And for a partnership firm, what you will take? So for a partnership firm, you will take capital contribution of a partnership firm, and then you will add back undistributed profit, and from these two things you will reduce three things. What you will reduce? Number one, you will reduce accumulated losses. Number two, you will reduce deferred expenses. Number three, you will reduce miscellaneous expenses. So can I say usually this is the only way we calculate net worth, na, own capital less the accumulated losses, etc. So this is the way you will calculate net worth of partnership firm. I hope it is clear. Next point. Next point is relative. This is relative has same meaning. This debt instrument, this is na, have same meaning as given. So these are just a reference. So these things, that reference things, they will not ask you. What they will ask you, which are the independent point over here. So relative, this is same meaning as given under Companies Act. So the definition which you have studied in Companies Act is same definition is applicable for relative over here. Then this is resident individual means PRI. Can I say when I was teaching you FEMA, I told you so that if you stay so many days in India, then you will be treated as resident. So that is what they have written here, that the person who is PRI is called as resident. So nothing new. And then they have just clarified that that person has to be a natural person. So here whenever they will talk about resident individual, they will be talking about natural human being like you and me people. And whenever they will be talking about Indian entity, they will be talking about four people. Four people means Indian company, Indian body corporate, Indian partnership firm, like that, Indian LLP, like that. So they are saying that. Then RFC, same meaning as we have studied. So I have already taught you when I was teaching you FEMA what is RFC. Then this is SEBI means same person which is registered under SEBI Act 1992. Society means which is registered under Society Act. Then this is subsidiary or step down subsidiary, means foreign entity which has a control on it. So can say if Microsoft or a Facebook has control on some subsidiary or a step down subsidiary, so we will call them as what? We will call them subsidiary or step down subsidiary of a Microsoft, like that. So these are very straightaway things. See, there are few very complicated things, few manageable things. So we'll do it nicely, don't worry. Then strategic sector already taught you. And now what is sweat equity shares? Please understand what is sweat equity shares. When I was teaching you, I told you one thing. Like I am telling you one thing, I mean to say, there are certain technical know-how directors or employee shares. They give it to the company, and against that company give them shares at a discounted price. So those are sweat equity shares. For example, you know, recently when the COVID has happened, that time lot of scientists, they have created a formula for medicine, and then those companies who have manufactured those medicines, can I say, to those scientists, they have given shares at a discounted price to their employees. Scientists are also employed at a discounted price. So those are sweat equity shares. So it is like a ESOP only, but these are two again some technical know-how when you are sharing with a company. So company give you shares at a discounted price. So those are sweat equity shares. Then this is trust, means same thing, which is which is registered under Indian Trust Act. Venture capital fund means which is registered with SEBI. Then this is whatever is not defined over here. Can I say the word and expression used but not defined in these rules shall have same meaning as given in that particular act or rules or regulations. So whatever explanation is given over here, you will take that. If some explanation is not given over here, then in that respective act, rules, regulations, whatever is given, will follow that. Who will going to control this entire this thing? Overseas investment rule. So since it is related to money, and that too money outside India, it will be controlled by, the entire rules will be issued by RBI. All the directions and everything will be given by RBI. I hope it is clear. Now to whom these rules will not be applicable? To whom these rules will not be applicable? So please understand, can I say, when a financial institute is making an investment in IFSC, then these rules are not applicable. Not applicable means relaxation has been given, ease out has been given, relaxation has been provided. So they have ease out the provisions. What they are saying, when a financial institute is making an investment, when a financial institute is making an investment in IFSC, so in that situation, can I say these rules will not be applicable. So they have relaxed this. Second, when you are making an investment out of RFC, then also these rules will not be applicable. The rules which we are going to learn for overseas direct investment or overseas investment. So these rules will not be applicable when the investment is made. This overseas investment rules will not be applicable when the investment is made out of RFC, because usually RFC is a fund where the government has given relaxation, and that's why this is, if you are making an investment out of RFC account, then these rules will not be applicable. You can do it freely. Then this is if these investment is made out of foreign currency resource. When this made out of foreign currency resource outside India by a person who is employed in India for a specific duration, that is, if you are working in India on a temporary basis, that is, the period of work over here is not more than 3 years. If you are working for temporary basis, in that situation, and though you are working, means since you are working for a temporary basis, but outside India you have earned lot of money, and in your foreign currency resource you have saved those money. So can I say, if you are making from those foreign currency resource, and since you are on a temporary basis in India, that's why if you are making an overseas investment from a foreign currency resource which is outside India, then in that situation these rules will not be applicable. Or when it is made as per section 6 subsection 4, that is, when a person has made some investment when he was non-resident, then let's say now he is resident, government says it's okay. If you have made an investment when you are non-resident and now you are a resident, then in that situation these rules will not be applicable. So in 4th situation these rules will not be applicable. Number 1, when financial institute is making an IFSC outside India. Number 2, when it is done out of RFC account. Number 3, it is done out of foreign currency resource. And number 4, and you are in India on a temporary basis. And number 4, when it is made by non-resident, like the investment is by resident, but when the investment has happened, originally happened, then that person was non-resident. So when you have made the investment, you were non-resident, but now you are resident, so you can still continue holding it. So like that. Then this is financial institute as same meaning which is given in IFSC Act 2019. Then they have given a segregation of debt instrument and non-debt instrument. Now this is absolutely not important. I'll just read it once for you. A debt instrument will include all loan kind of thing, government debt, bond, corporate bond, then any securitization structure, SARFAESI Act, securitization structure, but which is not in the form of equity or any type of borrowing, loans, etc. Depository receipt when the value derived from debt securities. So these are debt instrument. What is non-debt instrument? Is so all equity kind of thing, na? When the investment is made in equity, or when there is a capital contribution in LLP, or when there is a foreign direct investment, alternative investment fund, these are always in a equity nature. Mutual fund, these are usually in the equity nature. Then securitization structure, or when you are doing investment in immovable property, or any depository receipt whose value is derived from equity capital or contribution to trust. So these are more or less equity kind of thing which is treated as non-debt instrument. You can read it once, but not very important from exam point of view. Now, if this is something important, point number 6, what they are trying to say. See, these rules have came recently. Now, there was a lot of investment made under earlier rules. Now, since earlier rules have been deleted, what about those investment which is already made under earlier rules? So, this is whatever investment is made under earlier rules will now continue to apply under new rules. So, can I say if I have made any investment or Reliance has made any overseas investment which under older law, so this is now the new law will govern those investment which is made by Reliance. So it is like a you can say that older law since it is deleted, new law will apply to older investments. So any investment made outside India under earlier law, in accordance with the act, means under earlier law, shall held as on date of publication shall be deemed to have been applied under these rules. Means can I say will continue to apply, means these rules will apply to those old investments. Clear? And now when you are making overseas investment, there is a good chances that you will get equity shares, right issue. So they say since right issue you get shares at a discounted price, under bonus you get it free of cost. So obviously government will not restrict it, because then it will be loss to the Indian investor and eventually a loss to a Indian government. And that's why this is, if PRI has made any investment, and now they are getting in a foreign equity capital, foreign entity, so they can also receive right shares on that, they can receive bonus shares on that. And let's say they don't want right shares and they want to renounce it, they can also renounce their right. I hope it is clear. So you can get right shares, you can get bonus shares like of the foreign entity in which you have already made the investment, and in case you want to renounce your right, you can also renounce the right. Next point, prohibition on investment outside India. This is a simple point. It's like they are saying that whatever investment you are making, overseas investment you are making, you have to comply the rules which is issued now. If you are making any investment which is not as per rules, then you are not supposed to make those investment. So that is what this is, save as otherwise, means otherwise then given in the law, like whatever is given in the law, you have to do as per that only. You cannot do something which is not as per law or which is not as per rules. So even if this point would have not been there, can I say this is obvious, once rules has been issued, you have to do investment as per rules only. Now this is important. Understand, overseas investment. Now they are talking about overseas investment. Please understand one thing, what they are saying, that overseas investment which you are making now, that they should be in a bona fide business activity. So can I say whenever you are making an overseas investment, those investment has to be in a bona fide business activity. So you should be into a bona fide business activity. Now they have written it, but can I say even if it would have not written, obvious obviously can I say you have to comply with that. You cannot do something which is dummy thing. So can I say whenever I am making an investment in a foreign entity, they should do some genuine activity. They should be into a bona fide business activity. So this is an obvious point, but they have given it. Then this is there, if those foreign entity has subsidiary and step down subsidiary, they should comply with the structural requirement also of that foreign entity. So these 2 points they have written. And now they have given one important point which you have to understand for an exam point of view. This is that if you are making an overseas investment, including swap of security, means derivatives, in a foreign entity which is registered in Pakistan, then you need prior approval of central government. So I can make, let's say I am an Indian entity, Indian party, I want to make an investment in a foreign entity, and those foreign entities registered across world, I can do it. But this is if you are planning to do in a foreign entity which is registered in Pakistan, take a prior approval from central government. So can I say these, obviously you know why, because we do all that thing with Pakistan. So this is if that a foreign entity is in Pakistan, take our prior approval, then only you can do it. Then says bona fide activity means those business which is allowed in India as well as in foreign country, wherever that foreign entity is situated. So can I say it shall be a permissible business in India as well as in foreign country, then it will be treated as bona fide business activity. And now can I say there are several limits which we will be learning later on. So this is notwithstanding anything contained in these rules or foreign exchange management overseas investment regulations 22, this is central government may on an application made to it permit financial commitment in strategic sector above limit. So can I say here they are saying CG can permit, but then CG will permit it after once the application is made by RBI more than the limit given in the law. If that financial commitment is in which sector? Strategic sector. I have already told you what is strategic sector. So if it is into a strategic sector, government later on will learn some limit. Government has already prescribed those limits, but you want to make investment beyond those limits. So this is CG can permit this once RBI will make an application to them, to CG, provided the investment is in strategic sector. Then this is RBI can make RBI can allow to make an investment or transfer an investment for a sufficient reason if the application is made through AD category bank. So if it is strategic sector, can say CG will be involved. Other sector, if there is a genuine reason to make or transfer an investment, transfer means sale and investment, and if you have a genuine reason and if you are making an application through AD bank, then RBI can permit that as well. So these are just approval granting provisions. Now what they are saying, prohibition, overseas investment, if overseas investment is made by PRI, now government has a right to prohibit certain type of countries foreign entity, and if government will prohibit that, then in that case you cannot make that overseas investment. Now it is not the provision, I am just explaining you for the understanding purpose. Let's say government has prohibited, let's say example Iraq. So government once if this is not the provision, just an example, if government has prohibited Iraq, then can I say we cannot make investment in any foreign entity which is there in Iraq. So this is what they are saying, that government has this power, but as of now no one is prohibited, so this point is again not relevant for you. Then again can I say RBI can set limit how much amount you can send outside India and how much amount beyond which you need approval. So RBI can set the limit. So later on these limits will also come, we'll learn it. So RBI will set limit how much financial commitment an Indian party can make in foreign entity and without approval, then beyond which with approval how much amount an Indian party can make an investment in a foreign entity. So those limits can be set by whom? RBI after doing consultation with central government. So like that. And now this is that if any person whose name is appearing as a NPA or who is an willful defaulter or who is under an investigation. So please understand, can I say, let's say Indian party is there, X Limited. Now that X Limited has taken loan from some bank in India, let's say, and he has not repaid that money to the Indian bank. So that X Limited will appear as a NPA in X Limited books of account. That X Limited, again let's say X Limited has taken loan from some Indian bank, and the X Limited has not paid to that Indian bank for a certain specific purpose, and that's why X Limited has been classified as NPA. Are you understanding? X Limited has been classified as NPA. So that X Limited want to make overseas investment. Now government will say, boss, you are not paying someone, and that's why you have been classified as NPA, and now you want to make investment outside India. So this is a very severe issue. Second thing, let's say X Limited has made some willful defaulter, not paid the money, willful defaulter, and X Limited has appeared on a RBI willful defaulter list, or X Limited is under an investigation by CBI etc. or by ED etc. So this is that X Limited now want to make overseas investment, they have to take NOC from them people. For example, if X Limited has appeared as an NPA on SBI, so they have to take approval of SBI. If X Limited has been appeared on a willful defaulter list by any bank, so they have to take the approval from that bank. Or if X Limited is under investigation by CBI or ED, so they have to take NOC from this CBI and ED. So whoever bank has classified you as NPA or willful defaulter, or if investigation is with CBI or ED, so before making an investment by X Limited outside India, the X Limited has to take NOC from these banks or these CBI or ED. And that is what they are saying, they have to take NOC. I am just straight away teaching you, because more and more if I keep on reading now, you may lose the entire control of the provision. That's why I am just reading it for you nicely, explaining you nicely, and wherever reading is necessary, I will read it for you. So this is, you have to take NOC, and now this regulatory authority has to give NOC within 60 days. Means ideally they should give NOC, or even if they want to reject whatever they want to do, they have to do it within 60 days. But let's say these authorities, those banks who have classified X Limited as NPA, or those that CBI or ED, they have not given NOC to X Limited within 60 days, then it will be presumed that they have given NOC. You are not saying anything now, we'll presume that NOC has been received and X Limited can make a overseas investment. So that is what they are saying. Clear? Shall we proceed? In now, there are certain total in 5 schedules we will going to learn in future. So they have just given the reference of those schedules. So I am not going to read it for now, because these schedules anyway we will going to cover in some time. So we will read then, but just read it for your reference. What they are saying, when ODI is made by Indian entity, I already told you who is Indian entity, everybody. So Indian entity, if ODI is made by whom? Indian entity, then that will be governed by Schedule 1. If OPI is made by Indian entity, then that will be governed by Schedule 2. If overseas investment by resident individual, now this is not Indian entity, na? It is not company, partnership firm, LLP, body corporate, this is not that. It is a resident individual, natural person, and they want to make overseas investment. So that will be governed by Schedule 3. Then this is that if any person, any resident in India who is not Indian entity or resident individual and want to make overseas investment, so that will be governed by Schedule 4, because those are not covered above in first 3 schedules. Then says, if you want to make an overseas investment in IFSC, who want to make it PRI, then that is governed by Schedule 5. So this is the 5 schedules we will learn in future. So now let us proceed. Pricing. Whenever you are making overseas investment, can I say government will be very much concerned about the price at which you are making an investment, everybody. So government says that if you are making overseas investment, those investment can be made only at arm's length price. So those investments can be made at arm's length price. So if you are acquiring any equity shares of a foreign entity, or transferring, so that can be at a arm's length price. Now this is that arm's length price will be calculated as per international accepted valuation standards, as per international accepted pricing methodology or valuation standard. So this is about pricing. At what price you can acquire investment, like Indian party can, because if more money will go outside India for a less investment, less securities, so can I say it will be lost to India because there will be more outflow of Indian fund. That's why they are saying that it should be at a arm's length price. Then once you have purchased the equity, there is a chances that you want to sell those equities. So this is transfer or liquidation. You want to sell those investments. So Indian party, let's say, acquired shares of a Microsoft, and now they want to sell the shares of the Microsoft. So if they want to sell the shares of the Microsoft, what will be the pattern? So this is that a resident can transfer it to the eligible resident. Means I am resident, I have made an investment in Facebook, and now those investments which I have made in where? Facebook, can I say I can sell it to another resident, provided that resident is also eligible resident, or to any non-resident. So they are saying that a resident can transfer the shares or investment to another resident, but that another resident has to be eligible, or to any non-resident. PROI can be anyone. Fine. So I can sell it to some resident who is eligible, or I can sell it to non-resident also. I can transfer it by way of merger amalgamation also. Under merger what happens? Now you don't get money. Let's say Microsoft get merged with another foreign entity. So I am going to give those shares of Microsoft and I will get the shares of another entity. So this is in that case, if the transfer is by way of merger, in that case you have to take the approval of competent authority. If for example, like there is in India competent authority CCI, so if let's say merger is in USA, so some approval granting authority, Competition Commission of India, is there in India for merger amalgamation. So similarly, can I say there will be some that type of authority in USA. So can I say those mergers permitted, allowed, it is no problem, but then those mergers should be approved by, or approval should be taken by those approval granting authority outside India, that is in host country, wherever that merger has been taken place, and approval of those approval granting authority has been taken before transfer of shares. So under amalgamation, if you are transferring the shares investment, it is permitted, but those amalgamation need to be approved by those authority which is governing in that country. Then says that if you are selling your entire investment, if you are making entire investment, then you should get full money. What they are saying, that let's say I have a 12% shares of Microsoft and I want to sell off entire 12% shares of Microsoft. Are you listening? I have a 12% shares of Microsoft and I want to sell entire 12% shares of Microsoft. So this is okay, you can sell the entire 12% shares of Microsoft, but if you want to sell the 12% shares of Microsoft, you should get the full amount of those 12% shares. You should get full money of those 12% shares. It is written over here, and you can sell only after holding it for 1 year. So I want to sell 12% shares of Microsoft, I should hold those investments for at least 1 year and then I can sell it, but in that situation I should get 100% amount of 12% shares of Microsoft. Is this clear? But these provisions will not be applicable when you are transferring through amalgamation, because obviously in that case I am not going to get the money. There is an exchange, na? I will like Microsoft shares will go, but then some other company shares will come. So can I say in that situation that you should hold it for 1 year or should get entire money? This provision will not applicable, but then this is obviously. So by way of amalgamation, if you are transferring the shares, even if it is entire holding of yours, they are saying it is permitted, even if you have not held it for 1 year or you have not received the entire money. Anyways you will not receive because there is a exchange. Then this is the fifth point, is very obvious point. They are saying holding of any investment is not permitted if you have not acquired it initially as per law. If for example there are a lot of provisions is there in the law, they are saying that initially when you have made the investment, at that time you have not complied with the law. Now you still want to hold those investment. This is no, you have to liquidate it, you have to sell it. So can I say there is a lot of provision we have studied. If you have purchased or if you have made an investment as per that law, I can continue holding it, but initially when I have made the investment, it was in violation of the law. Obviously when the government will come to know this, government will punish us and will ask us to sell the shares. I cannot continue holding it. Now next point is, what is restructuring? I have made an investment outside India. So when I have made an investment outside India, let's say in Microsoft. So for Microsoft, can I say I will be lender? Microsoft is supposed to make payment to me. Are you understanding? For Microsoft, I will be what? Tell me. I'll be lender and Microsoft is supposed to make payment to me. So this restructuring is about that only. What they are saying, that if any person is a resident in India, if any person is a resident in India who has made ODI, and when a foreign entity is doing restructuring of the balance sheet, restructuring means they are trying to reduce our claim. And why they are doing it? Because they have got loss in last 2 years. Please understand. Can I say when I have made an investment in Microsoft, Microsoft has to give me money. Fine. So they have to give me X money. They are saying, but if Microsoft is getting loss since last 2 years, then obviously they will not going to give me the entire money which I am supposed to receive because they are into loss. So they will reduce my claim, means I will get less money. So technically in India the inflow will be less from Microsoft because I will get less money. This is, it is allowed. It is allowed. So restructuring means Reliance has, let's say, made an investment in Microsoft and Microsoft is getting loss since last 2 years. So Microsoft will going to restructure the balance sheet, and Microsoft, when they will restructure the balance sheet, they will reduce the claim amount of Reliance and Reliance will get less money. So government says that if Reliance will get less money, it is permitted, provided Microsoft has incurred loss in last 2 years and the reduction is proportionate amount to the accumulated losses. Means what? Means Microsoft has incurred loss of, let's say, 7% in last 2 years. Microsoft has incurred loss of 7% in last 2 years. So what will happen, you know? Microsoft has incurred loss of 7% in last 2 years. So they can reduce only 7% claim amount of Reliance. So whatever the amount Microsoft is supposed to give to Reliance, that amount will be less by 7%. So to put it in simple language, what I am trying to say, allowed when foreign entity has incurred loss in last 2 years, first of all. Second, amount owed by foreign entity to PRI. So can say that amount, like let's say it is 50 lakhs, that amount owed by, which is supposed to give by the Microsoft to Reliance. So that amount will be reduced by proportionate loss. So can I say that 50 lakhs, if let's say Microsoft has incurred loss of 5% or 7% or 8%. So can I say they are saying that, let's say they are incurred loss for 7%. So they can reduce that 50 lakhs claim, Reliance, 50 lakhs claim only by 7%, and the remaining amount is the final amount which a foreign entity will give it to Reliance. I hope it is clear. So can I say any Indian entity who has given money to foreign entity, who has made an investment in foreign entity, ideally the entire amount they should get. But if that foreign entity has incurred loss in last 2 years, then that foreign entity, whatever the percentage of loss they have incurred, similar percentage of amount, they can reduce it from the claim of Indian entity, and only the balance amount they will give it to Indian entity, and that is permitted. So though the India will get less amount, but it is permitted if that is a proportionate reduction. But then they have added one more point. They said that if the reduction is 10 million USD, so a very big amount, 10 million USD amount is there, or if the reduction is 20% of the claim, means Reliance is supposed to receive 50 lakhs, so 20% is 10 lakhs. They are supposed, so let's say if they are reducing their claim by 10 lakhs, that is 20% of the total value, or it is not 20% or more, it is less than 20%, but the absolute value is 10 million. In either of the situation, they says that reduction can be only by way of arm's length price. The reduction can be at a arm's length price. So this was a tricky provision. I will recreate for you. What they are saying, when their other foreign entity is doing restructuring, it is permitted in two situations. Number one, this restructuring is done by foreign entity only when the losses are there in last 2 years and the amount will be reduced the amount will be reduced only by the same percentage by which percentage they have incurred the loss. And if the reduction of the value, if the diminution, the reduction of the value which the foreign entity is supposed to give it to Indian entity, if the reduction is more than $10 million, or it is the value is more than 20% of the total stake of an Indian entity, in these two situations it can be done only at arm's length price. I hope it is clear. Now, when you cannot make ODI, restrictions and prohibition, when you cannot make ODI, so this is when a foreign entity is engaged in, this is similar what you know when like it is more or less similar what prohibition you have studied in FEMA earlier. They are saying when ODI is restricted or prohibited. So this is resident cannot make ODI if a foreign entity is engaged in real estate or gambling, or if the foreign entity is engaged in financial product and that financial product is deriving from Indian rupees. If for a real estate, I will explain you, then I will explain you gambling, and then the third point. If this is real estate includes trading in TDR, buying and selling of real estate or trading in TDR. It means, can I say, if any foreign entity is engaged in trading in TDR, then can I say I cannot make investment in that foreign entity? First point you all understood. When a foreign entity is engaged in trading in TDR, in that situation, can I say I cannot make ODI in that foreign entity? But this is real estate does not include development of township, construction, residential or commercial premise. It means if a foreign entity is engaged in trading in TDR, I cannot make, Indian party cannot make ODI in that foreign entity. But if that foreign entity is engaged in development of township, residential, commercial premise, that means it will not be treated as this thing. It will not be treated as what? It will not be treated as real estate. That means that ODI is permitted. So two foreign entities there. One is engaged in trading in TDR. Indian entity cannot make investment there. Another is engaged in development of township or construction of building, etc. So Indian entity can make an investment in that foreign entity. Gambling, obviously government does not want to promote that. So gambling you cannot make if that foreign entity is engaged in gambling. Then this is if foreign entity is engaged in dealing in financial product, but that financial product is deriving their value from Indian rupee. Government says if you ultimately the value is derived from Indian rupee only, then straight away invest in India only. Why you want to go outside India? You want to flow money outside India. It should be an independent thing. If the value is deriving from an Indian rupee only, then there is no sense of making that investment. I hope it is clear. Shall we proceed? Then this is if you are making an startup, ODI in startups, they are saying it is not allowed. You can do it only through internal accruals. You cannot do it from borrowing. Means I cannot borrow the money and I can make an investment in startup. Government says motivate startup in India. Why you want to motivate startup in host country? So if you are making a investment in startup, but it is your own income, internal accruals, if from that you can make a startup in the host country, that is in foreign country, but you want to borrow the money and make an investment in startup in the host country, that is in foreign country, so that is not permitted. That is not permitted. Or you want to make financial commitment in the foreign entity which has more than 2 layers. So you have already studied in 186 of Companies Act. This is more than 2 layers are not permitted. Now they are saying you want to make an overseas investment. That means your money will go outside India in a foreign entity, and that foreign entity has more than 2 layers. So it is a slightly risky. Probably you may try to send hawala money or something like that outside India. So we will not take that risk. So if the foreign entity has more than 2 layers, then it is not permitted. Clear? Now, but these restrictions will not be applicable. Means not applicable means you can make an investment when the entity is engaged in banking, NBFC, insurance or government company. So these restrictions will not be applicable for whom? For banking company, NBFC, insurance company, government company. So whatever you have studied above, restriction, this is, it is not applicable to whom? It is not applicable to banking company, NBFC, insurance company and government company. To these 4 people, these restrictions will not be applicable. I hope it is clear. Next point. Whatever the mode of payment will be there, considerations payment will be there, all these rules will be specified by whom? Will be specified by RBI. So all the mode of payment and everything will be specified by RBI. RBI will say how much money you can invest, how much money outflow is permitted, and everything will be termed by whom? Will be termed by RBI. I hope it is clear. So it is obvious point. Now next point is about immutable property. When you are holding an immutable property outside India, so there are certain restrictions which I will teach you now. What they are saying? They are saying if you are making an investment outside India, so when you are making an investment outside India, there are certain restrictions they have taught us. What they are saying? I mean not investment, immutable property. If you have immutable property outside India or you want to acquire immutable property outside India into sale, normally you need RBI approval. Normally you need RBI approval. So any resident, obviously the restriction will be for resident, any resident who want to purchase, acquire immutable property outside India or want to acquire or transfer immutable property outside India, usually they need RBI approval unless it is generally allowed by special permission or general permission. So if there is any general permission, special permission by RBI, you can acquire or transfer immutable property outside India. All these restrictions are for obviously resident. Resident want to acquire immutable property or transfer immutable property outside India. There is a general or special permission, then you can do it. But otherwise you need prior approval of RBI. But then immediately they have given the general permission. They said in following situation to acquire or transfer immutable property outside India, approval is not required. When the person is a national of a foreign state, means I am PRI because I am staying here. Because FEMA talks about stay, na? So if you are staying in India, you will become PRI. But then they says though you are a PRI, you are a person of a foreign national, and since you are a person of a foreign national, they are saying that in that situation you can acquire or transfer permitted without RBI approval. Or if you have acquired before 8th July 1947, then also you can transfer it without RBI approval. Or if you are acquiring at a lease for 5 years, maximum 5 years, then also you can do it without RBI approval. So in this situation, when you are a person of a foreign national, or if you have acquired before 8th July 1947, or if you have taken on lease up to 5 years, in these three situations, you don't need RBI approval. Next. Then this is if PRI is getting immutable property, may acquire immutable property outside India by way of inheritance, they can get it, or gift, they can get it. Why? Because you are getting it free of cost. So you can get it by way of inheritance or gift. Or you want to purchase from PRI, then also it is permitted. So by way of inheritance it is permitted, by way of gift also, and you can also buy it from a PRI. PRI is buying from PRI, but this PRI has purchased it after complying all the laws. So I am PRI, Mr. X is PRI, I am buying from Mr. X. It is allowed, but Mr. X should have purchased it as per law. Mr. Gannu should have purchased it as per law. Are you understanding? Are you understanding? Fine. Next point. This is PRI may acquire immovable property. PRI may acquire immovable property from PROI. So first point was for PRI from PRI. Second point is PRI is acquiring it from PRI is acquiring from PROI. PRI is acquiring from PROI. This is PRI can acquire from PROI. It is permitted provided they have acquired it by way of inheritance. Number one, they have acquired it by way of inheritance. So PROI has given immutable property to PRI by way of inheritance. It is permitted without RBI approval. Or it is purchased from RFC account, then also it is permitted. So if PRI is buying from PROI out of RFC account, then also it is permitted. Or if they have purchased it from LRS you know na, then also it is permitted. So if PRI has purchased from PROI from LRS account, liberalized remittance scheme, then also it is permitted. Or PRI is jointly acquiring along with his relative, and his relative is PROI. So I am PRI, my relative is PROI, and we together acquiring jointly. We are co-owners, we are acquiring jointly, then also it is permitted. Or if it is out of income or sale proceeds of the asset, out of income or sale proceeds other than ODI, if there is any income or sale proceed, and from that I am acquiring, then also I can acquire. So what the points? From PRI can acquire from another PRI by way of inheritance, gift, etc. Or they can purchase also from another PRI provided that another PRI has acquired it by way of law, proper complying law. PRI can acquire from PROI by way of inheritance, or out of RFC account they can purchase, out of LRS they can purchase, or jointly they can acquire along with PROI as a joint owner, or they can buy it out of income of sale of an asset other than ODI. So like that. And then this is a Indian entity can also acquire overseas office, business or residential premise for staff. Basically, you are buying the business premises. So I am an Indian entity. And I want to buy some business premise outside India, some residential premise outside India for my staff, residential premise for my staff. So this is a business property. Business property can be purchased. Then this is PRI, who has acquired this, may transfer. So this point is about transfer. Till now we have discussed about purchase. Now they are saying PRI may transfer it to the immovable property outside India. They may transfer it to another PRI if that PRI is eligible. So they can sell it to, I am the PRI, I can sell it to another PRI, but that another PRI should be eligible. So till point number 3 we have talked about what? We have talked about purchase. Point number 4 we are talking about sale. So one PRI can sell it to another PRI, but that another PRI should be also be eligible person to buy the immovable property. Then this is that they can also create a charge, means they are taking loan and against the property and they want to create charge on that property. So even that is permitted. Or they want to hold. Now what they are saying, that any money they have received, immovable property, if they can continue, any immovable property they have received, they can continue holding it only when they have acquired it initially as per law. So say if I have acquired any immovable property and that acquisition is not as per law, so I cannot hold it anymore, I have to sell it immediately. The government will get to know, they will punish me. So this is, you can continue holding immovable property only when you have purchased as per law. So this is the obvious point. Let's proceed. Okay, so now we are going to discuss Schedule 1. Schedule 1 is about ODI. ODI is made by Indian entity. So when Indian entity is making what? Tell me, ODI. In that case, Schedule 1 will also need to be complied with. So this is Indian entity who makes ODI. Can I say, first of all, can I say the entity need to be in the bona fide business. So the entity need to be under which activity? Bona fide business activity, number 1. Number 2, if the investment can be made by what mode? So first point is what? An Indian entity who is making ODI. So that ODI need to be done by way of what? That need to be bona fide business activity. Number 1. Number 2, this is that subscription can be. Then ODI, how you do? So that we already know. It can say it can be a subscription of memorandum, or you can acquire it by way of bidding process, or you can acquire by way of right issue or bonus issue. So these things we have already studied, or by capitalization, or by swap of securities, or if there is a merger demerger, that way also I can acquire. So these are some very simple and obvious point which is written. Now the point is slightly important, you have to learn it for exam. This is if Indian entity who is engaged in financial service. If Indian entity who is engaged in financial service can make ODI in a foreign entity, who is also engaged in financial service, means what? A Indian entity is there, this Indian entity is in a here. This Indian entity is in a financial service, so they can make investment in a foreign entity which is also in a financial service, provided that Indian entity which is in a financial service should comply with 3 conditions. What are the conditions? This is that Indian entity should be getting profit in last 3 years, and it should be registered with the regulatory authorities, and the approval of the regulatory authority should be taken, like SEBI, etc. These are regulatory authority. So this is that Indian entity which is into a financial service activity can also make investment into a foreign entity which is also in a financial service activity. But that Indian entity which is making an investment in a foreign entity should get profit in last 3 years, should be registered with the financial sector regulator, and should also take approval of the financial sector regulator to do these activities. Financial sector regulator example is like SEBI in India. Now, so what they are saying, that Indian entity can, which is into a financial service sector, can make an investment in a foreign entity which is also in a financial service sector, but this is that Indian entity should get profit in last 3 years, it shall be registered with financial service regulator, and it shall also take approval. Shall also take what? Tell me first. Approval from the financial sector regulators. Now, then the second point they are saying that Indian entity which is not there in financial service. First point was Indian entity in a financial service. Second is Indian entity which is not in a financial service can make a investment ODI in a foreign entity which is in a financial service except banking or insurance. So second point is, first point is Indian entity which is in financial service can make investment in foreign entity in financial service. Second is Indian entity which is not in financial service can make in financial service, but that financial service should not be banking, insurance. Apart from that, any financial service, provided there is a profit in last 3 years. Provided there is a profit in last 3 years. So there has to be a profit in last 3 years. Third point, Indian entity which is not in insurance sector can make ODI into a foreign entity which is there in general or in health insurance. So even that is permitted. So can I say if you are a Indian entity which is not in insurance sector can make investment ODI in financial entity which is in general or health insurance. So now let us understand this one by one, what they are saying. See, there is a Indian entity which is in financial service can make investment in a foreign entity which is in financial service if that Indian entity which is in financial service is making profit in last 3 years, registered and approved. Second point, Indian entity which is not in a financial service can make an investment in a foreign entity which is in financial service provided it is not banking, insurance if there is a profit in last 3 years. Then Indian entity which is not in insurance can also make ODI in a foreign entity which is in insurance. Clear? Shall we proceed? Then this is a last 3 years profit we have to see, but obviously can I say during COVID 2021 and 21-22 due to COVID people were not having a profit. So this is these 2 years can be skipped, excluded if due to COVID they have no net profit. So this is 2 years relaxation they have given for the 3 years net profit. So it is like that. Now this is notwithstanding anything contained in this paragraph, overseas investment by bank or NBFC shall be regulated by RBI. That means whatever investment will be made by overseas investment made by bank or NBFC will be regulated by what? RBI. So usually these financial service SEBI control, so that is there, but then they say that RBI will also control them. And now how much financial commitment you can make, total financial commitment? So Indian entity, can I say taken together total financial commitment in foreign entity, how much they can do? This is it shall not get more than 4% of net worth. This Indian entity's 400% of net worth is the ceiling limit. I told you na, up to which the investment can be made into a foreign entity. Taken together all financial commitment of all foreign entity together, can I say this amount cannot go more than 400% of net worth of that Indian entity. So this is the ceiling limit. Or if any limit is given by RBI separately, then you can take that separate approval of RBI. But otherwise, this 400% of net worth of Indian entity is the ceiling limit up to which the financial commitment can be made into a foreign entity. Then this is this total financial commitment will not include capitalization of the retained earning, but it will include. So in financial commitment, what all things will come? So this is money raised by ADR, GDI, this will come in financial commitment. Then money raised by ECB. Then they are saying that financial commitment made by Maharatna, Navratna or Mini Ratna by public sector company will not come in the limit. The 400% limit will include what? ADR, GDR, will include ECB, but it will not include financial commitment made by Maharatna, Navratna, Mini Ratna. These are public sector important companies. So government have excluded them outside the limit of that 400% of net worth. Schedule 2. So Schedule 2 is meant for overseas portfolio investment, OPI, when it is meant by an Indian entity. So when an Indian entity is doing what? OPI, then the provision is given in Schedule 2. So what they are saying, that an Indian entity can make OPI up to 50% of net worth. So this is how much? 50% of net worth. It shall not exceed 50% of net worth, and the net worth will see as on last audited balance sheet. I told you not preceding more than 18 months is the last audited balance sheet. So like that. So OPI can be made up to 50% of net worth. Earlier you have seen that 400% of net worth, and this is 50% of net worth OPI. Fine. So this is a very simple thing. So they can do this. And then this is if a entity is a listed Indian company, they can make OPI by way of reinvestment. They can make OPI by way of reinvestment. Now tell me friends, what is the meaning of reinvestment? So when you have done the disinvestment, means you have sold your securities and you got the money, and then you want to again reinvest it in OPI, you can do it. So listed Indian company can do it by way of reinvestment. And as far as unlisted public Indian entity is concerned, unlisted, listed is in second point, in third point unlisted, they can do OPI only by way of 3, 4, 5, 6. Now what is 3, 4, 5, 6 of this paragraph? So see this one, 3, 4, 5, 6. See, this is 3, that is right shares, bonus shares. 4, capitalization. 5, swap of securities. 6, merger, demerger. So can I say, if it is an unlisted Indian entity, they can make an OPI only by right shares, bonus shares, swap of securities, merger, demerger, and these things. So these are the schedule 2. So let us recollect entire schedule 2 provision. What they are saying: OPI can be made by an Indian entity only when first of all it shall not exceed 50% of net worth, number 1. Number 2, when the investment is made by an listed Indian company, so they can do it only by way of reinvestment. Number 3, an unlisted Indian company can make an OPI only by right shares, bonus shares, swap of securities, merger, like that. So they can do it. So these are the provision of schedule 2. See, as I told you, again as I told you, the weightage for FEMA and the length of the chapter is very big. Plus this is just a one topic of the entire FEMA, and that's why I'm not trying to dig too much into it. I'm just trying you to explain you in the basic form so that it is sufficient for exam point of view. They will not going to dig it in exam. They will just ask you the straight provisions in exam. So you just have to understand it at face and you have to write in exam. Now the third is schedule 3. Under schedule 3 it is overseas investment. See, earlier we studied ODI, then we studied OPI. In schedule 3 we are learning overseas investment, and by whom? By resident individual. So this is resident individual. If you will see in schedule 2 it was Indian entity. If you will see in schedule 1 it was again Indian entity. But in schedule 1 it was ODI. In schedule 2 it was OPI. But in schedule 3 it is overseas investment. Now what they are trying to say, that if you are making an overseas investment, please understand, it is given by whom? By resident individual. So we all know that whenever we talk about resident individual, if for them the investment limit is always LRS, so it shall not go beyond LRS. It has to be within LRS. So the limit is LRS. Then they are giving some different point, that when a resident individual is making overseas investment by way of ODI, so when resident individual is making investment by way of ODI in any foreign entity, then that foreign entity should not engage in financial services. So they shall not be into a financial services. That foreign entity shall not have subsidiary, that is subsidiary or step down subsidiary, where the resident individual has a control. So this is, I have written here also for you in a simplified way. So when overseas investment is made by resident PRI, then in that case first of all it should be within what? It should be within LRS. It shall not go beyond LRS, number 1. Number 2, if you are doing it by way of ODI, so you can do it by way of ODI, but then that person shall not engage in, resident individual is doing now, so that foreign entity shall not engage in financial services. Basically they shall engage in non-financial services, and that foreign entity shall not have subsidiary, and the individual should have control in that foreign entity. So these 3 things you have to understand. Fine. Second point, look here. If they are doing OPI, it is permitted including reinvestment. So it is allowed. Even you can do reinvestment. Now I hope you know what is reinvestment. When you sell the securities and you get the money and you again invest in OPI, this is reinvestment. Even that is permitted. Or if they are doing it by way of ODI or OPI, fine. If they are doing it by way of ODI and OPI, then this is allowed in the following way. Like they can do capitalization, they can do swap of securities, they can do by way of bonus shares, right shares, gift, inheritance, sweat equity, qualification shares, ESOP, fine. So these things they can do it. So I have written it for you. OPI is permitted, everybody. OPI is allowed. ODI, OPI is allowed by way of capitalization, swap, gift, inheritance, sweat equity, qualification, ESOP. So now let's try to remember this. What they are saying, when an overseas investment is made by a resident PRI, they can do it only within LRS, and then this is, if the ODI is done, it shall not be into a financial services and it shall not have any subsidiary, and the PRI shall have control. Then as far as OPI is concerned, it is permitted, but then this is, it is permitted and it is also allowed by way of reinvestment. ODI, OPI you are doing, you can do it by way of capitalization, swap of securities, gift, inheritance, sweat equity, qualification shares, ESOP, etc. So these are just, you have to read it once, don't get into too much, because then again the weightage and the marks is not that you can invest too much of time on it. Try to make it concise as much as possible. Now in this point, last point, they are saying that if you are doing ODI in clause EFGH, what is EFGH? This point. So this is this point made in foreign equity, then whether or not such foreign entity is engaged in financial services or subsidiary or where a resident individual has control. Means if you are doing ODI in this situation, ODI, then there is no restriction of what? Then there is no restriction of, tell me, no restriction of having financial service activity or having subsidiary. These restrictions will not be applicable in 4 situations, the bracket which I have done. So these, in these 4 situations, there is no restriction for ODI. Fine. Now, then what they are saying further, that acquisition of less than 10% of equity share capital without control under this is also allowed by way of OPI. So this point number F, G and H, they are saying point F, G and H, less than 10% of equity capital of a foreign entity without control is also allowed under FGH, and it will be treated as OPI. So that we have studied. And now please understand what they are saying. Foreign entity will be considered as a financial service activity if it undertakes any activity which is carried out by an entity in India, require registration with or is regulated as a financial sector regulator in India. Means, can I say, if any foreign entity is engaged in some activity which otherwise require to be registered as a financial service provider in India, then that foreign entity will be treated as financial service provider. Means what? Let's say X institute is there in USA, and they are doing X activity. But then they are saying that assume that that institute, if they are doing that X activity in India, and if it is qualified to be called as what? Financial service provider, and they are supposed to get registered as a financial service from the financial service regulator, that is SEBI, etc. Then that foreign entity, even in foreign, for us we will be treated as what? Financial service provider. So basically financial service provider means here you are providing financial service which are otherwise treated as financial service in India, will also be treated as financial service outside India. So this is the point. Then see what I am trying to say now, please beta, just read it once. You have seen the entire video, now just go through with the entire notes once, and then I am sure you will be very comfortable. These are a very different point. So at first go you may not be very comfortable, but once you will read it again after my explanation, I am sure you will become comfortable with it. Then acquisition by way of gift or inheritance. This is an resident individual may without any limit receive foreign securities. So they are saying resident individual can receive without any limit foreign securities by way of inheritance. So if you are receiving what? If resident individual is receiving what? foreign securities. What they are saying, and they are receiving it by way of inheritance. Then they are saying they can receive it from PRI, and there is no restriction, no limit. They can receive any amount they want. They can receive any amount they want. There is no limit. Then a resident individual without any limit may acquire foreign securities by way of gift. If they are receiving by way of gift from PRI, who is also his relative, that also can be received, and there is no limit. And third point, they are saying, if they are receiving, if the resident individual is receiving by way of gift but from a PROI, then that has to be within the FCRA limit. We have already studied FCRA limit, so it has to be within that FCRA limit. So there are 3 points. Number 1, look here. If you are receiving foreign securities, and that foreign securities received by way of inheritance from PRI, then it is allowed without limit. The first point which we have studied, inheritance without limit. Then if you are receiving it by way of gift from a relative, and that relative is PRI, then also allowed without limit. And if you are receiving by way of gift from PROI, then it is allowed, but within FCRA limit. So these are the things. Just read it once. Shall we proceed now? Next point. Next point, they are talking about acquisition of shares or interest under ESOP or employee benefit scheme or sweat equity shares. What they are trying to say, please understand that if a resident individual is an employee who is a employee or a director of a office in India or a branch of an overseas entity. So the entity is outside India, but the office is in India, or the branch is in India. So he is a director of that office in India or a branch in India, but the entity is not in India, the entity is outside India. In that situation, they can receive shares without any limit. Remember, only this much. They can receive shares without any limit. Under which plan? Under ESOP. So you can remember like this, that you are a director or an employee of, let's say, Microsoft, which has office in India or branch in India, and in that branch or office you are a director or an employee. So you can receive shares under ESOP, and there is no limit on those receiving of the shares, because you are getting anyway at a very lower dirt cheap price. Na? So that's, I hope it is clear. Shall we proceed? Just read this much only. Now, next point is overseas individual by a PRI other than Indian entity and resident individual. So you see, first we studied Schedule 1, which was for ODI by Indian entity, then Schedule 2, OPI by Indian entity, then we have studied Schedule 3. Look here, Schedule 3, this is overseas investment by resident individual. So Indian entity and resident individual is already covered. Now they are talking about Schedule 4. This is by person other than Indian entity and resident individual, because Indian entity is covered in Schedule 1 and 2 and resident individual is covered in Schedule 3. Schedule 3. So can I say other than those people, if they are making what? And if they are PRI, obviously overseas investment means it is done by PRI only, na? So if you are PRI but you are not Indian entity and resident individual, so who you are? A trust. Trust can be one example. Trust is not Indian entity or a resident individual, I mean to say. So, and if they are making overseas investment, they will be covered in Schedule 4. So what they are saying, that if ODI is made by registered trust or society, can they do it? Yes. But what they are saying is that the person which is a registered trust, they should be engaged in either educational sector or hospital. And when they are doing it, they need prior approval of what? Prior approval of RBI. Along with that, there are certain conditions they have to fulfill. So now basically we are learning an overseas investment. We are learning what? We are learning overseas investment made by whom? Overseas investment made by registered trust or society. So when an overseas investment is made by registered trust or an overseas investment is made by society, they should be first engaged in educational sector or hospital sector, and they should take RBI prior approval. Then they are saying that foreign entity should be engaged in the same sector as of Indian trust. Means the Indian trust is in education sector. So the foreign entity should be in education where they are making an investment. Or if they are into hospital, then that foreign entity should also be in hospital. Then they are saying the trust or the society should get profit in last 3 years. So there should be a profit in last 3 financial year. Then the trust shall form trust deed. So there has to be a trust deed for that trust. So they have to make the trust deed. We also call it memorandum for that trust. Then they are saying the investment which you do, every trust has their council body, executive committee. Like in our company there is a board of director, like the similar way in the trust there is a executive committee. So they are the people who control the trust. So you have to take their approval also before making the trust. So what they are saying, for condition, when overseas investment is made by whom? Overseas investment is made by registered trust or society. In that first point we are doing the discussions about ODI. If ODI is made by the registered trust. So when the ODI is made by the registered trust, they are saying it shall be, the trust shall be into education hospital sector, or and then this is you should take prior approval of RBI. The amount which you are doing by way of ODI, can say the other foreign entity should be in the similar sector, same sector as you are. Like if you are in education or hospital, they shall be in education or hospital. Then they are saying that the trust should not be into loss. They should get profit in last 3 years. Then the trust should form their trust deed, like the partnership firm make partnership deed, trust should make trust deed, and the trust have their controlling body and they are called as executive committee. So approval of that committee is also needed before an investment. Then they are saying a trust, sometimes trust also need a special license from Ministry of Home Affairs. So let's say if the trust has taken a special license or permission from the Ministry of Home Affairs. So whenever you are giving application to submitted to the AD category bank, so along with that application you will also give the special license given by the MOH. So can I say when I am giving an application to AD category bank, it can say along with that application, if some approval, special permission is taken by me from MOHA, Ministry of Home Affairs. So that application, that approval letter I will attach along with the what we say, the statement which we submit. We will attach along with that. Clear? Shall we proceed? Next point. Overseas investment by mutual fund or venture capital fund or alternative investment fund. So if there is a mutual fund, there is a venture capital fund, or there is a alternative investment fund, and if they are making what? They are making overseas investment. So what they are trying to say, that when a mutual fund, venture capital fund or alternative investment fund, they want to acquire or transfer foreign securities, so they will not only govern by RBI, they will also be governed by SEBI. This point is very obvious now. They will be controlled by RBI as well as SEBI. They will be controlled by RBI as well as SEBI. So can I say, whenever the mutual fund, venture capital fund and alternative investment fund is making an overseas investment, can I say they will take approval of RBI, and along with RBI approval they will also take approval of SEBI, Security Exchange Board of India. And what they are trying to say? They are trying to say that these two approval is needed only. Apart from that, this is that every transaction they are doing, that has to be done through AD category bank. The transaction should be routed through AD category bank. And then this is whatever investment is made by them, whatever investment is made by them, that will always be treated as OPI. So whatever investment made by mutual fund, venture capital, AIF, this is whatever given in this rule, just leave it. It will always be treated as OPI, because they never make any investment to take control. The intention is always to earn out of it. So it is always treated as OPI. So now let us put it together. They are saying that if overseas investment is made by mutual fund, venture capital fund, alternative investment fund, they have to take RBI approval. Also they have to take the approval. The entire transaction need to be routed through AD category bank. Then this is, these investments will always be treated as OPI. These investment will always be treated as OPI. Fine. Now next point. They are saying if you are a clearing corporation of a stock exchange, and if you are a clearing member, what they are saying, any person being a SEBI approved clearing corporation or a clearing member they may acquire, hold and transfer foreign securities as a collateral from foreign portfolio investor. See, you are a member of a stock exchange in India, you are a clearing corporation of a stock exchange in India, and then there is a foreign portfolio investor. Now, there is a possibility that you are giving fund to that foreign portfolio investor. So, when you give fund to the foreign portfolio investor, what will be your intention? Tell me. When you give fund to the foreign portfolio investor, your intention will be what? So, when you give fund to the foreign portfolio investor, your intention will be to get some collateral. So, now let us say that foreign portfolio investor will give you the collateral, and those collateral will be foreign securities. So, can I say Indian clearing corporation or clearing members is getting foreign securities from a foreign portfolio investor? Now, don't you think as a collateral they need to hold it? So, if they want to hold it, and let's assume they want to hold it outside India, so don't you think they have to open demat with foreign depositories? They have to open demat with whom? Tell me fast. Foreign depositories. And they can do this, and let's say assume if they are not getting their money, what they can do is they can sell this and they can bring the money in India. They can sell those securities and they can bring the money in India. If in future they will not be getting their money back, so they will sell off the collateral, they will liquidate the collateral and they will bring the money in India. So, this is very simple point. Then again, for similar point, domestic depositories. You know, in India, domestic depositories, can I say against IDR, they hold securities, na yaar. So, this is what they are saying, that domestic depositories can hold IDR, and then there is a regulation, they have to follow the regulation. So, there is nothing in point 4, basically what they are trying to say, that if the domestic depository is there and they want to hold foreign security, for this you need to know how IDR operates. So, when IDR has been issued, so what happens now, shares are held outside India, and against that IDR is issued by domestic depository in India. So, those domestic depository can do it, but then they have to follow regulation. So, in 4th point, there is nothing much you will get. Now, it's just a basic point. Then 5th point is slightly important. What they are saying, that if AD category bank is there, they can do overseas investment, but for them they have to comply with the norms of host country. Host country means what? AD category bank is there and they have overseas branch also. They can acquire or transfer foreign securities, but for that matter, they have to follow all the banking provisions which is applicable in the host country, that is in foreign country where they want to do these transactions. So, these are some points. I just want you to just read it once and then we can proceed. Okay, now I am moving on to Schedule 5. Now, what is Schedule 5? This is overseas investment in IFSC, International Financial Service Center. Now, please understand. Overseas investment in IFSC by a PRI. Now, let us understand this, what they are trying to say. When you are making an overseas investment in IFSC, this investment is made by PRI. This is, you will anyway comply the schedules which is given in Schedule 1, 2, 3, 4. So, can I say whatever schedule we have studied there, all these schedules is anyway applicable to them. But some extra point is there which we have to study now. So, what they are saying, if you are making an investment in IFSC, whatever provisions is given in Schedule 1, 2, 3, 4 is also applicable over here. So, they have just copied it from the above schedule, Schedule 1, 2, 3, 4. It is also applicable over here. But then this is that if ODI is made in an IFSC, fine. So, when an ODI is made in an what? IFSC, can you say some extra point they have given? This is the approval of financial sector regulator is also needed. So, you need approval of financial sector regulator and it shall be decided within how many days? 45 days. Then it is need to be decided within how many days? 45 days. So, what I told you, look here, in IFSC, the provision will be same as given in Schedule 1, 2, 3, 4. Then this is, if you are doing ODI, then you need approval of financial sector regulator and you need it within 45 days. Then this is that if you are an Indian entity, but you are not engaged in financial service activity. So, the Indian entity is not engaged in financial service activity and they want to make ODI. So they in a foreign entity, and the foreign entity is engaged in financial service activity. So this is, it is permitted provided they shall not be into a banking and insurance. Similar point we have studied earlier, but then there the condition was there that you should have a net profit, but here those conditions are not applicable. So even if there is not a net profit, there is no net profit, an Indian entity which is not engaged in financial service can make an investment, can make an ODI in a foreign entity which is in financial, provided they shall not be in banking and insurance, and it is permitted even if there is no profit. So non-financial to financial is allowed except banking and insurance, even when there is no profit. Next point. PRI can also make an investment. PRI can also make an investment by way of investment fund or by way of vehicle set up in IFSC, but then that will be as a OPI, it will be held as a OPI. So can I say they can also make by way of investment fund or vehicle. What is vehicle? They pull the fund together and then they send money outside India. So that is investment fund or vehicle. And then the last point they are talking is the resident individual may make ODI in a foreign entity, including an entity engaged in financial service activity except in banking and insurance, provided they don't have subsidiary and the resident individual has control over it. So what they are trying to say, resident individual can say they can make investment in foreign entity, but they shall not be into a banking and insurance in a IFSC I am talking, but then that foreign entity shall not have subsidiary and the resident individual shall have control over it. So let's conclude what they are saying. IFSC schedule 1, 2, 3, 4 provision is also applicable over here. Then this is when you are making it by way of ODI, you need approval of financial sector regulator and you have to take approval within 45 days. Non-financial Indian entity can make it in a financial, but that shall not be into a banking and insurance. It is permitted even if there is no profit. And then this is that resident individual can pull the fund together and as an investment vehicle they can send it in IFSC, or if resident individual can also make an investment in financial entity except that financial entity shall not be banking and insurance, and that foreign entity shall not have subsidiary and resident individual as a control. So these are some points which we have discussed. Now, so basically recognized stock exchange in IFSC will be treated as recognized stock exchange outside India. This point is very obvious. For so many times I have already explained you that anything in IFSC is treated as outside India. So any stock exchange in IFSC will be treated as if that stock exchange is outside India. By this we have completed entire rules, friends. Now we will be moving on to regulations. Once we will be done with regulations, things will get completed. So let's proceed now. Next regulation we are learning Foreign Exchange Management Overseas Regulation 2022. So this is the regulation which we are learning. First, the three things they have given is very simple. What they are saying, act means this act, Foreign Management Act. Debt instrument means the same meaning which is given in overseas investment rules. And so these are the very simple thing which is always written. So basically point starts from 3. Now please understand, in first point what they are talking, financial commitment by Indian entity by modes other than equity capital. So if an Indian entity want to make any financial commitment not in equity form but in other form, can they do this? So basically now we are going to learn that an Indian entity is there and that Indian entity want to make financial commitment, means want to make an investment, to put it in a layman term. They want to put the investment in which form? Like other than equity form they want to put an investment. So can they do this? So they are saying they can do it in a debt instrument form or non-fund based commitment form. So basically, can I say I am a, let's say, Indian entity and I want to make a financial commitment outside India in a foreign entity. Can I do it? I don't want to do it by way of equity. So can I do it by other mode? So they have said that yes, you can do it by other mode. You can do it by debt instrument and you can do it by non-fund based commitment form. So you can do it in these two forms. But then there are some conditions which you have to fulfill. Number 1 condition, this is that Indian entity should be eligible to make ODI. Number 1, the Indian entity should be eligible to make ODI. Number 2, the Indian entity should have already made the ODI. So there you should have already done the ODI, then you can do the other investment also. First you have to do the ODI, then only you can do the other investment. And then the Indian entity should take control over such foreign entity, and the financial commitment amount will include the 4 regulations provision which we are going to discuss now. So now let me put it in a simple way. What I am trying to say, that if an Indian entity want to make a financial commitment, want to make an investment in a foreign entity, and they don't want it to do it by way of equity capital, can they do it by other means? This is yes. They can make an investment by way of debt instrument, they can make an investment by way of non-fund based commitment. So by these 2 means they can do it, but then there are some conditions they have to fulfill. First of all, they shall be eligible to make ODI. They have already made the ODI in that foreign entity where they want to do this debt instrument or investment in their debt instrument or non-fund based commitment, and then they should take control over that foreign entity. And how much financial commitment they can do, or for financial commitment what are the limits, what are the things will come in the limit. So now we will going to discuss that, because we have already studied now 400% of net worth is allowed for ODI. So now can I say, for that matter you have to understand that whatever financial commitment which you are doing, how much will be included, so that it shall not exceed the 400% of net worth. So now one by one, let's say if an Indian entity is making investment by way of debt. So what the first point they are saying, that whenever you are making an investment in a foreign entity in their debt, that means, can I say what they will give you? They will give you interest now. So this is that interest should be at a arm's length price. If for so many time you must have studied this in direct tax also. What is arm's length price? Arm's length price is price at which an unrelated people do the transaction. So can I say, let's say I am an Indian entity, I want to make a financial commitment in a foreign entity. So I am an Indian entity, I want to do financial commitment in a foreign entity. So the question is, can you do this? Answer is yes. Then this is that if you are doing it other than equity, that means you are doing it by debt, so you will get interest. The rate of interest shall not be less than the arm's length price. Then next way, you can give guarantee also. Even that is included in the financial commitment. Now that guarantee can be corporate guarantee, or it can be performance guarantee, or it can be personal guarantee, or it can be bank guarantee. Again repeat what I said, if you are making an investment by way of guarantee, it can be corporate guarantee, it can be performance guarantee, it can be personal guarantee, and it can be bank guarantee. But all guarantee taken together will be included in the financial commitment. How much? So if it is joint guarantee, you will take 100%. Means what? Can I say, let's say I have given a guarantee and Mr. X has also given a guarantee, and the guarantee amount is 100 crore. So normally what we think now, that Mr. X and me, we have given guarantee for something which is of 100 crore. So technically we two are sharing it. So it should be into half. Answer is no. Can I say we will take entire 100 crore? Means what? If some guarantee is made by me and jointly with Mr. X, and the guarantee value is 100 crore. So even I will take 100 crore and even Mr. X will take 100 crore. Did you understood? So let's say I have given guarantee in a foreign entity, and that the guarantee value is 100 crore, and I have given that guarantee along with Mr. X. Even if the Mr. X is jointly sharing those guarantee with me, I will still take the entire 100 crore in my calculation. And for performance guarantee, we have already studied now that performance guarantee means we are giving the guarantee that the other person may or may not do something. So the probability is always 50% of doing and 50% of not doing, and that's why performance guarantee always we take how much? 50%. So joint guarantee will take 100%, performance guarantee 50%. So this much you have to study from here. Next, can I say you can also pledge or create charge? See, please understand, I am an Indian entity. Now since I am an Indian entity, what will happen in real life? I am an Indian entity, so I have made an investment in a foreign entity. Now those shares which I have made an investment in a foreign entity is nothing but investment only for me. So I can pledge those shares to take loan. So that is what going to be discussed over here. What they are saying, that if whatever equity capital I am holding in a foreign entity, I can pledge those equity and I can take loan. See, for example, normally what happens now, I have a shares of XYZ company and I need loan. So I will mortgage my those shares of XYZ company and I will take loan na. On the same lines, if I have a shares in a foreign entity, again repeat, if I have a shares in a foreign entity and that foreign entity shares I want to like pledge so that I can take loan, so that is permitted, but that will be included also in the limit of financial commitment. What they are saying, you can pledge it, and then they are saying you can also create charge on it. Then if foreign, since I have made an ODI in the foreign entity, can I say I have a control over that foreign entity, so I can mortgage the assets of the foreign entity which is in India to avail the loan, which can be for fund based or non-fund based loan. Or if the asset is outside India of that foreign entity, I can mortgage or create charge on that also for availing fund based or non-fund based loan. So basically this entire point talks about what? So this entire point talks about that when I want to pledge something or when I want to create charge for something, can I say I can do it, but when I want to do it, they are saying that when you want to pledge the equity capital of the foreign entity so that you can take loan, it is permitted. You can create charge also. And then for what you are creating charge, you can create charge on the assets which is in India or assets outside India of that foreign entity. And why you are creating it? You are creating it so that you can avail the fund based and non-fund based facility. So you can take the loan, that's why you are creating charge. Then the next point they are talking is how much will be included in the financial commitment. This is you take value of pledge or the charge or the amount of the facility. So what you will take, value of pledge or charge, and you will compare that with amount of facility, and whatever will be the less amount, that amount will only come in financial commitment. So just understand it from the base, just don't get into it, just understand it in the base point. Now we will move to the next point. Okay, next point we are going to discuss acquisition or transfer by way of deferred payment. Please understand, when a person resident in India, that is PRI, when PRI is buying equity capital, fine, from whom they are taking it? From PROI, or this is the first point, PRI is buying from a PROI, fine, or PROI is buying from PRI. So either PRI is buying equity from PROI or PROI is buying equity from PRI, and this is by way of ODI. By what means they are doing? By way of ODI. The payment of amount of consideration for equity capital may be deferred for such period as agreed between them. Means what? Now for some time I will just take up an example that PRI is buying equity from a PROI. Let's say PRI is the buyer and he is buying equity from PROI. So he is seller, fine. Or other way around, take PROI is, yeah, correct, buyer and PROI is seller. So when they are giving equity, what they are saying, the entire payment is not made, payment is deferred. Payment is what? Deferred. So when PRI is buying equity from PROI or PROI is buying equity from PRI, but entire amount is not made at once, they are saying the amount is made in tranches. So let's say the foreign security, so in that case they are saying that the payment can be made in tranches, it is permitted, that's not an issue. But then in that situation you have to fulfill some condition. What they are saying, the foreign security is equivalent to amount of total consideration shall be transferred upfront by the seller to the buyer. Means what? Means what? Let's say PRI is buying equity of 100 crore from PROI, fine. PRI is buying equity of rupees 100 crore from PROI. Now PROI, he is supposed to receive the money. Now they are saying that if the money is given in tranches, the dealing has to be done in tranches only. Means what? If only 20 crore rupees is received, then equity of only 20 crore will be transferred. If the balance 30 crore received, then transfer equity of balance 30 crore. Means 100 crore transaction is done. 100 crore transaction is done. But if the transaction is done in tranches, like if the payment is received in bits and part. So give equivalent value of equity every time. So let's say 100 crore rupees securities are there. 20 crore payment given, give 20 crore security. Remaining 30 crore payment given, give 30 crore security. Remaining 50 crore equity given, now give 50 crore rupees security. So give only that amount of money for which you are receiving security, or give that amount of security only for which you are receiving a particular amount of money. So that way, if the payment is deferred, securities allotment should also be deferred, like that. And then this is the deferred part will be treated as non-fund based commitment. Non-fund based commitment is like a future promise now that will pay you. So for example, 20 crore rupees received and 20 crore security is given. Now the 80 crore rupees which is not yet received, because the total transaction value is of 100 crore. So 80 crore will be shown as a promise that the money will be paid in future whenever the security will be received, or security will be given in future whenever the money is received. So this is like that. But in case if there is any delay in the payment, then the buyer has to be indemnified. Means interest also need to be given if there is any further delay. Means there is some agreement. Up to that you are anyway going to make the payment, but if you are doing the delay even beyond that period, so even interest will be given. So in this entire thing only two things are important, that see, when you are making payment in tranches, then in that case security should also be given in tranches only. If you are receiving only 20 crore, you should not give security of 100 crore, vice versa. Next point, whenever the PRI is making overseas investment, how he can make the payment? All approved channel. The payment can be done by way of banking channel. The payment can be done from the fund which is applicable under this act. It can be done by way of swap of securities. It can be done by way of ADR, GDR, ECB, like that. So all these are approved mode through which the payment can be made. Next point, obligation of PRI. A PRI in India acquiring equity in a foreign entity which is reckoned as ODI shall submit to the AD bank share certificate. What they are saying, please understand. A PRI is there, he is acquiring equity capital, and this equity capital he is acquiring under ODI. So they are saying that whenever they are acquiring equity capital under ODI, all the documents need to be done through AD category bank, and they will give AD bank share certificate, and all these things should be given within 6 months. Within how much time? 6 months. So you can just remember this, that whenever you are doing the transaction, you have to give AD bank share certificate, and that has to be given within 6 months. Then you have to take UIN number, unique identification number. Like in FEMA, ECB, you take LRN number, loan registration number. Similarly, here you will take unique identification number. Means, can I say this number will be attached to that entire ODI, and whatever the outflow will be of the fund, can I say this will be against this unique identification number only. So this number will be used to track the entire outflow of the fund. So you have to obtain UIN number, unique identification number. So PRI through its designated AD bank shall obtain unique identification number, and who will give this? It will be given by RBI. RBI will give this unique identification number, and RBI will give the unique identification number for the foreign entity in which the ODI is intended to be made. Then this is that now this PRI will be having particular UIN number, and his ODI will be tracked through that UIN number only. So this is an identification number which will be used in future. And now this ODI money can be like this can be sold also, na? ODI equity can be sold also. So if PRI is realized and repatriate, means what? They are selling the equity and they are taking back the money in India. So if they are selling the equity and they are bringing the money in India, it shall be brought within 90 days. Within how many days it shall be brought? It shall be brought within 90 days. So this is what they are saying. Then they are saying a PRI can, for making ODI, they can also give earnest money. So this is the provision that for PRI they can give also the earnest money. Like now let us understand this again. So what I told you, first thing, can I say what is the mode of payment for ODI can be done? So this is that it can be done from a fund which is approved banking channel. Then this says that it can be done through swap equity, it can be done through ADR, GDR, ECB, like that. Then they say that if PRI is there and they want to do it through ODI, in the then there is a AD bank share certificate they have to submit. It has to be done within 6 months. Every ODI should be given unique identification number, and ODI will be tracked through unique identification number. When you sell any equity of the ODI, you should realize and repatriate it within 90 days. So this is the point. Then this is that if PRI is there, you can also give that money. Now reporting requirement. Now what is reporting requirement? Please understand what they are saying. When the reporting will be done, look here. A reporting for ODI, look here, reporting. Now how the reporting will be done? First of all, can I say it is done through AD category bank? So the reporting is done through whom? Tell me first. It is done through AD category bank. So a PRI who has made ODI, who has made what? ODI. Can I say if he is doing any financial commitment, can I say when he will do reporting? He will do reporting at the time of sending the money. So can I say for ODI, when a PRI is making ODI at the time of financial commitment, whenever he is doing financial commitment at the time of sending the money, he should do the reporting. So this is the first point. If he is doing disinvestment, means he is selling the equity. So in that case, from 30 days, whenever he will receive the money, from that period within 30 days, he should report. And if there is a restructuring, means there is a loss to a foreign entity and he is doing the restructuring. So from the date of restructuring within 30 days, he should report. So there are three things I told you for ODI. In case of financial commitment, you should do reporting when you are sending the money. For disinvestment within 30 days, again from the date you have realized the money, and restructuring from the date of restructuring within 30 days, you should report. Then for OPI, they are saying that the person resident in India who is not an resident individual and who is making OPI, they will do reporting within 60 days from the half year end. Means first half year end is April to September. So within 60 days from the September end for OPI, and second is from October to March. So it will be from March, within 31st March, within 60 days. So for OPI, reporting will be within 60 days from the half year end. So it will go like that. So this is the reporting. Then they are saying if OPI is by way of acquisition of shares under ESOP, then the reporting will be done by office in India or the branch of an overseas entity in India. So if let's say shares are allotted under employee stock ownership plan, in that situation they are saying that the shares which is allotted by the employer, you can say, and that employer has office in India or that employer has branch, means that employer is overseas entity but they have branch in India. So who will do this reporting? Whenever the shares are allotted under ESOP by way of OPI, in that situation they are saying office in India or the branch which is in India will do the reporting. So this is what they are doing. Clear? Next point. A person resident in India. I am trying my best to keep it as short as possible, but I am trying to cover almost all important things. I have done a proper research so that I am telling you exactly what you have to remember, because trust me, everything remembering is impossible. Impossible as in, if you put that much time you can remember, but then again as a weightage and everything, you should do it to the extent it is relevant for the exam. Now then the next point they are saying, if the person is PRI and he has done ODI, he shall also do the annual performance report. Why? Because can I say ODI means you are having a big amount of stake in the company. So that company's performance is also very important for you. So can I say, let's say I have taken 14% shares of Microsoft. So I will send the Microsoft's annual performance report every year by 31st December. But let's assume that the foreign entity's year end is 31st December. Then I can not give on the same day. So they are saying in that case it will be in the next year of the 31st December. So every year for ODI investment, let's say I have invested I have taken Microsoft 14% shares. So I will give annual performance report of Microsoft by 31st December. But if the Microsoft has 31st December year end, so this year's 31st December's year end, I will submit it to the next year 31st December. That is 12 months time is given if your year ending is 31st December, because many foreign entity has a calendar year also year end. So in that case, if the year end is 31st December, they will give 1 year time, that is 12 months. Then they are saying if the PRI is having less than 10% and they have no control, in that situation no reporting is required. A, because your holding is less than 10% and you have no control. That means, can I say, anyways, their success and failure will not damage you that much. So in that case, you don't have to report. Or if the foreign entity is under liquidation, there is no sense of report. See, it is in liquidation anyways, we know what will happen. So in that situation also you don't have to report. Then they say that you have to give CA certificate, etc. So those are monotonous point. Now delay in reporting. There are a lot of reporting you have to do in regulation 9 and lot of reporting you have to do in regulation 10. So if you fail to do those reporting which is given in regulation 9 and regulation 10, can I say, and if there is a delay, in that situation they are saying that you can still submit the report with late submission fees. Fine, but the delay cannot be more than 3 years. So can I say there are a lot of reporting we have to do in regulation 9, there are a lot of reporting we have to do in regulation 10. So ideally you should do it within the time given in the law, but let's say if there is a delay, then you can do the reporting, but then that situation they are saying that first of all, when you are doing the delay in reporting, you have to give the late submission fees. Second, can I say the delay cannot go beyond the 3 years. So maximum delay possible is 3 years. Now, its second point is what? Second point is, can I say this regulation came this year only. So there are possibilities that corresponding reporting of regulation 9 and regulation 10 under the older regulation, the delay is already done in the older regulation. So they are saying that if you have done some delay in the older regulation only and now the new regulation came, no problem, you can still pay the late fees, and even if you fall in the older regulation, still you can do the reporting under the new regulation after paying late submission fees. So you have to just remember these important points, that is more than sufficient. And then the last point they are saying, restriction on further financial commitment or transfer. See what they are trying to say, if the person is PRI, if the person is what, tell me, PRI, in that situation, can I say if he has delayed in the reporting, so till the period he does not rectify the delay, he cannot make further financial commitment. So let's say there is a delay in reporting, government says that now you want to do further financial commitment, so stop. You want to do the further financial commitment, first rectify the delay which you have done, pay the late submission fee, file the report, and then only you can now make any further financial commitment. Till that period you cannot make any further financial commitment. So that's all in this. Now all the amendments I have covered. Last amendment being lengthy, I tried to summarize it to the extent possible, and all the important points I have told you, if you read that much also is sufficient. Just read that much and just go through with that by yourself once also. So by that all amendments are covered. Now I will just discuss question answers briefly. Okay, now we will be doing the discussion of question and answer. See, these are more or less very straight things, like it is more like a self-reading only. So without investing too much of time, I will try to cover it, the all important points, so that it will not be very much time consuming for you. So first of all, whatever I will tell you, just read, pause the video, read this entire case study, and then we can discuss this. Fine. Now read this. Fine. I hope you have gone through with the case studies. Now, there are several MCQs we will discuss. I want to tell you one thing. These, I am not going to discuss the all MCQs because most of the MCQs are just self-explanatory in nature. But still, for your reference, I will discuss few MCQ and then you can just read it out. In case whatever I have discussed today, you have any problem, you have JKSC helpline number, you can post me there. I will help you to clear with your doubts. First MCQ they are talking is, directors of SFIO shall be an officer to the Government of India having knowledge and experience in dealing with the matters relating to corporate affairs not below the rank of. So now this question is straight question from section 211. Under that we know that who can become the director of SFIO, Serious Fraud Investigation Office. So answer is C, Joint Secretary. So the level will be of at least Joint Secretary. I hope it is clear. So 1C, first C. Second, there is an investigation conducted under section 2123 wherein investigation continue beyond the time prescribed in the order and report has not been submitted to the CG shall be. Now see, this section itself is written, so you know this is from section 212. Now they have not submitted the investigation report, there is a delay. But what about the report? Whether the report will become invalid just because it is delay? Answer is no. So the report will still remain valid. B. Now next is, they are saying considering the expression of 2126, an offence under section 447 of Companies Act 2013 shall be what? This we have also studied in PMLA, also in 212. Tell me the offences mentioned under 2126 is what? The offences are cognizable and non-bailable. So in this case, can I say what are the offences are cognizable and non-bailable? So it's point 1 and 4. So 1 and 4 is B. So third answer will be B. Now let's move to the next question. The expression of officer and employee under section 2125 denotes what? So can I say that denotes current employee as well as past employee? So here it will be C, who or have been in employment. So current employee as well as past employee, both will be covered. So 4C. Now next is 5. The note of examination of Miss Smriti Shah, wherein she admitted her involvement in fraud and misappropriation, can be used as evidence against her if. So in that case, what all things you can do? You can say we can take in writing, we can make that person read the statement, we can take the person's signature. So these things will be there. So it is 1, 2 and 3. So it will be 5B. Now, so these are very straight MCQs. So you can just go through with remaining MCQs. I will straight away discuss question answers. Come to question answer now. Under question answer, question 11, this is Srinath, Smriti and Irfan. They are the directors of the company, which is renowned brand and sports item. Mr. Rahul is MD and Mr. Irfan is whole-time director, whose 4 years of tenure is still there. The average remuneration of Mr. Rahul, Srinath and Srimati and Smriti and Irfan are 84 lakhs, 21 lakhs, 18 lakhs and 48 lakhs. PSL acquired by Messrs. Rockman Sports. Mr. Srinath, Smriti and Irfan lost their office of director. Mr. Rahul also lost the office of director of MD, but during restructuring he got the position. So now they are talking whether who all will get the compensation. So first of all, as far as Srinath and Smriti is concerned, they will not get the compensation. Why? Because they are the director of the company. Are you understanding? So Srinath being a director of the company, they will not get the compensation. Who will, only MD and whole-time director can get the compensation. Srinath and Smriti is ordinary director, and being a ordinary director, they will not going to get any compensation. Now as far as Irfan is concerned, if you can see, Irfan is a whole-time director, and since he is a whole-time director, he can get the compensation. So this is one point. Now next, sir, Rahul is MD, so basically he could have got the compensation, but since he has been appointed as a managing director of the body corporate which is post restructuring, so basically he is not at loss, so he will not get compensation. Reason is different, but Srinath and Smriti will not get because they are other director, and this Rahul has got the position of MD, and that's why he will not get, but Irfan will get the compensation. So out of this 4, only the Irfan will going to get the compensation. Now next question, I just want you to read through this question and then I will discuss this question. Okay friends, so when you must have read with the question, you must have realized this question is from operation and mismanagement, and under this the first question they are asking is whether the minor can ask for compensation for lower dividend. If first of all, can I say giving no dividend or less dividend does not amount to operation. So neither this is operation nor mismanagement, and hence on this ground no application can be made because this does not amounts to operation and mismanagement. Then this is whether the petition is valid. So if you see they does not meet the number which we have studied under 241 and 244 we have studied now. So they does not meet those numbers also. So since the number is below the limit also, they cannot make an application. So neither their number like the application number is sufficient nor the ground is there, so no application can be made. I am just giving you the references. We are not going into too much of time consumption. Just keep on understanding. Now question 13. So Dr. Kishore Krishnan has opted to join as independent director in Rosemary Pharmaceuticals Limited, which manufacture various kinds of medicine under brand name. As an independent director, Dr. Krishna is of the view that he needs to be paid around 10,000 more than sitting fees as compared to other director. As far as sitting fees is concerned, we have studied that sitting fees to women director and independent director cannot be less than other director. That is one point. But here they are saying that independent director want more than other director. So law is silent about that. See, assuming that other director does not consist of women director. So what they are saying, independent director should not get less than other director. So technically speaking, should not get less than. So for more than they are silent. But here they have not said that how much amount other directors are receiving. So let's say if other directors are receiving 1 lakh rupees, then in that case to Dr. Krishna you cannot pay more than 10,000. Why? Because then it will become 1,10,000 and the ceiling limit is only 1 lakh. So you have to mention these 2 points that since other directors, independent director also cannot get more than 1 lakh. So if other directors are getting 1 lakh, in that situation independent director cannot get 1,10,000 like that. Question 14, just pause the video and read through with this. If when you have gone through with the question, you must have realized this question is from SEBI LODR, and under SEBI LODR I have given you the time limit, like before how many days you have to inform to the stock exchange regarding certain transactions which you regarding the board meeting which you are going to conduct. So in this question, can I say the board meeting is to be held on 9th January. So can I say for quarterly financial results you have to inform 5 clear days before, for buyback 2 clear days before, say for debentures 11 working days before, like that. So can I say from that 9th January you have to reduce those many days. When they says working days means you have to understand, whenever they says working days, can I say you have to ignore Saturday and Sunday. So you have to take answer accordingly. So these are the time limit you have to adjust from 9th January, and then you will get the day up to which the board meeting information should have been given. Question 15. Please read with this question. Now this question I want you to read it. This question is based on what? So beta, this question is based on IBC constitutional validity. Whether the IBC is constitutionally valid or not, because in this situation they said that there is a discrimination in the IBC. So the court has said no, there is no discrimination in IBC. They treat in a strict way, but that does not mean there is a discrimination, and hence finally they concluded that IBC is legally valid. Please read question 16. So if you read this question, you will find out that this question is from Foreign Exchange Management Act, and it is about immovable property concept. So they want to sell it. So can they sell it? Yes, they can sell it. It's a straight question. They can sell it, and then and they need RBI approval for it. So it is like that. So these questions, many questions you have also seen in book also. Next is next question is from Foreign Contribution Regulation Act. Now can I say earlier we used to study that foreign contribution if you receive, can I say you have to intimate, but now in that can I say they have made the amendment that if earlier the limit was 1 lakh rupees, and now the limit is 10 lakh rupees. Now the intimation need to be given only when the value is more than 10 lakhs. It's an amendment, like some time back only we have studied this. So can I say here the amount is not more than 10 lakhs, so intimation is not required. Second thing, if the value is less than 1 lakh rupees, then it is not a foreign contribution only. So the 80,000 thing is not a foreign contribution, and the thing which is more than 1 lakh is a foreign contribution, but intimation is not required. Please read question 18. When you have gone through with question 18, you must have realized that this question is from a Prevention of Money Laundering Act. Here the entire question is the person who is receiving bribe is engaged in PMLA and it is a proceeds of crime. But whether the person who is giving bribe is also covered? So answer is obviously yes. Can I say whichever party is directly or indirectly engaged or attempt to indulge or knowingly assist or knowingly is a party will be the part of proceeds of crime. So even the party who is giving the bribe will also be treated as proceeds of crime and engaged in money laundering. Question 19, please read it. So question 19 you must have seen, it is from Arbitration Act, and then here they have asked you two questions, that whether multiple conciliator can be appointed and who will elect the conciliator. So you can read the answer, it's a straight question. We have studied in second last page of our book, where there we have studied about conciliator, the provision straight away from there. Question 20, please read it. Question 20 is from a foreign company chapter. Under foreign company section 379, you know that if 50% or more share capital is held by Indian citizen or Indian body corporate jointly or in individually or jointly. So if they are getting it individually also, then also that foreign companies, Indian business will be treated as deemed Indian income, and for them, can I say, they have to follow the provision which is there for a foreign company as well as those provision which is prescribed by central government. Central government prescribe them usually those provisions which is there for an Indian company. So in this situation, if you'll see, the holding is more than 50%. So can I say that foreign companies, Indian business will be deemed Indian company, and for them they have to follow foreign company provision also, and the provision prescribed by CG for an Indian company, that also, and foreign company also. So friends, see, I know your exams are very near, so I have tried to keep this video as short as possible. I have extracted all the important provisions, but what happens, you know, sometime you have done revision long back, so that may be possible that you may not click it in one go or something like that. So if that happens with any of the provision, please, you have our CA final helpline number of JK Shah classes. You can post me there, and for any particular point, if you want detailed understanding, you can post me there. I'll help you out with that. So I have tried my best to help you out. God bless you. Study well. All the best for your exam. Thank you very much.